Okay, everyone, good morning, everyone, and happy Friday. Welcome, all of you, to SEPR, the Stanford Institute for Economic Policy Research. I'm Mark Duggan, the Trione Director of SEPR, and I'm so grateful that you're able to join us for today's policy forum, examining the past and the future of Social Security, a topic that is very much in the strike zone of the research that we support here at SEPR and that we aim to study. Our panelists and our speakers represent an important set of perspectives and broad set of perspectives, and I'm really looking forward to their presentations. Unfortunately, our lunch keynote speaker, Peter Orszag, can't be here in person because of an unexpected circumstance, but he is going to join us virtually, and that worked really well at our recent economic summit, so we feel optimistic about that going well, but you never know, but we're hopeful. Today, for those of you who saw me yesterday, you probably heard me say happy anniversary or something. Today is exactly 40 years and one day since the Social Security amendments of 1983 were enacted. Those reforms saved the program from insolvency and significantly changed taxes and benefits for the program. Meanwhile, a new report issued just a few weeks ago by the Social Security Board of Trustees projects the program's trust funds will be exhausted by 2034-ish, which is about 50 years after the 1983 amendments that I just referred to. So today's event arguably couldn't be more timely. We're going to be taking a look at the road that Social Security has traveled during the last 4 decades since the reforms, and also explore the paths ahead for the next round of reforms that may be needed. One important thing to remember about the 1983 reforms, they passed so for those of you who were following things or have studied the history since then, they were largely affected by the commission headed up by Alan Greenspan, and that were negotiated between President Reagan and Speaker of the House Tip O'Neill with some bipartisan compromise on Capitol Hill. It's not like looking great for bipartisan compromise on Capitol Hill at times, but you never know. You never know what tomorrow will bring. Hopefully that effort can be a model for policymakers as they weigh their alternatives. As a nonpartisan academic institution, our mission here at CEPR is to catalyze research that analyzes and informs better economic policies and make sure that research is available to government officials, to business leaders, and other academics who are in a position to use it, build upon it, and create positive change. And as all of you know with Social Security, there's no one obvious right way to do things. But to some extent, the research that we support helps people identify trade-offs so they can make the best possible decisions in a challenging environment. Here at CEPR, we mentor and support students and the next generation of economic scholars and policymakers, and we host events to discuss solutions and approaches to thorny economic issues like the one that we're dealing with here today. Social Security is a huge focus of our scholars' research. Gopi Shah Goda, who I'll be introducing more fully in just a minute, has done important work studying many aspects of the program. So have 2 of my predecessors as CEPR director, John Chauvin and Michael Boskin, as well as many of our other 100-plus faculty affiliates, which maybe isn't surprising since Social Security is the largest government program in human history. So it's an important program. A paper, I think it may have been, did we distribute some of them, Aline? A paper that I recently co-authored about a component of the 1983 amendments that was enacted over 40 years ago. The effect of its delayed retirement credit was just accepted for publication, so I'm kind of excited about that. So if you're out there and you have trouble sleeping at night, we have extra versions of that 59-page PDF available for you, and you can snuggle up with that if you're having insomnia on any given evening. It's really helpful, I bet, for that. But it was just accepted for publication by the Journal of Public Economics, but it was co-authored with 3 terrific people, 2 of whom are, one is a current Stanford graduate student, and the other just recently graduated from Stanford, both supported by CEPR. And the paper is really a good example of our mission in action because additionally, the 4th co-author on the paper, and by no means 4th in terms of her contribution, is Irina Dushi, who is an economist at the Social Security Administration. And it was really great to work with her, and while she was able to help us get access to administrative data for this project. And it's a good example of us collaborating with students, with people in government agencies to provide, to do research on policy important topics. And for those of you who are already familiar with us, I'm really very grateful for your continued support of the work that we're doing. Our research and our events happen because of your commitment to the work that we do. And if you're a relative newcomer in our orbit, I welcome you to explore our research more deeply and attend more of our events. For example, 10 days from today, we'll be joined by Richard Clarida, a former vice chair of the Federal Reserve, who is now PIMCO's global economic advisor. He's going to be talking about monetary policy in the post-pandemic era and some interesting topics like what happened at Silicon Valley Bank, which seems to be on a lot of people's minds lately. 4 weeks from today, we are co-hosting a State of the West symposium with our friends at the Bill Lane Center for the American West, where we will address the crisis along the US-Mexico border and much more. So if you're looking to engage with some of the most pressing issues facing our country and others around the world, we're here with the programming to provide those opportunities. I want to give a special thank you today to Gopi Shah-Goda. Gopi is one of our senior fellows here at CEPR, and she planned and organized this policy forum today. I'm going to hand things off to her in just a minute, but first let me just tell you a bit about her. In addition to being a senior fellow here at CEPR, Gopi is also a faculty research fellow at the National Bureau of Economic Research and a fellow of the Society of Actuaries. From July 2021 to July 2022, she served as a senior economist at the White House Council of Economic Advisors. She also served as CEPR's deputy director from September 2016 to July 2021. Gopi is really the perfect person to organize today's event. Her research focuses on how policy can best serve aging populations, and she studies the sustainability of public programs serving the elderly, how people make decisions about healthcare, saving, and retirement as they age, and the broader implications of the COVID-19 pandemic on health, labor supply, and entitlement programs. Some of her recent research has examined the effect of long-term care insurance on family members' work and location decisions, and how COVID-19 illness affects U.S. workers. Her work has appeared in a variety of leading economics journals and has been covered by many major media outlets. And very importantly to us here at CEPR, her work has frequently been cited in government reports, agency rulemaking, legislative bodies, and, as I said, in the popular press. And so with that, let me turn things over to Gopi Shah-Goda. Please join me in welcoming her.
Thank you so much, Mark, for that kind introduction and your support of the program today. I'm really excited for what the day will bring. And I wanted to thank all of you for joining us. So we have a very special day of sessions planned for you on a topic that is near and dear to my heart. I first learned about Social Security, its theoretical rationale, and the broader implications of the program when I took John Chauvin and Michael Boskin's graduate public finance course at this point many years ago. And my first job as a research assistant was performing the data analysis behind a paper that John co-authored with Sita Slavov entitled, "Has the Unified Budget Undermined the Federal Trust Funds?" And from that point forward, Social Security became a central part of my research agenda. And I now teach my students about the program. And one of my central messages is that even though you might not think something like Social Security affects, 20-something-year-olds, actually today and, tomorrow's workers actually bear much more of the implications of the fiscal imbalance of the program going forward. And so they really have a stake in how policies are changed going forward. And so I'm pleased to see some students in the room too. So if we can, So as you may have noticed, we are doing something a little bit different today. We're going to do a very short 3-question poll. And the way to access the poll is by either using the QR code that is shown or just directly visiting the website shown. And if you are tuning in virtually, I hope you will participate as well. So we're just trying to get a little bit of a pulse of the audience. And we hope to compare what the audience is thinking now to what they might be thinking at the end of the day. And we'll kind of show the results from this morning's poll in just a few moments. You don't need any special software to join, and it'll just take you a minute or two. Okay, so as Mark noted, there are some reading materials for you to grab, not only his paper, but also a policy brief that was written to accompany today's event about Social Security, just laying out some of the basic mechanics of the program and framing some of the issues that we're going to be discussing in greater detail. So I wanted to just end with some logistics for the day. Each session will feature a moderator and 2 panelists. The panelists will provide some brief remarks, followed by questions from the moderator, and then we'll open it up to questions from the audience. The first 2 sessions will help us understand how the program works, what happened as part of the 1983 reforms, and then the 4 decades since, and the financial status of the program. We'll also learn about how different demographic groups rely on Social Security and the distributional consequences of the program. Our lunch speaker, Peter Orszag, will deliver the keynote address, and we're thankful that he could still make these remarks virtually despite not being able to make it in person today. Peter will be kicking off our afternoon program where we will be looking ahead to the program's future. One session will touch on the political economy of reforming the program, and we will end the last session with what I expect will be a lively discussion of some tangible reform solutions and their trade-offs. There will be a short break in the morning and a short break in the afternoon, a slightly longer break to grab lunch, and a reception after the end of the program in our courtyard. So I also just want to make one quick announcement that may be of interest to some members of this audience. Sita Slavov, who I mentioned before, and I are preparing to submit a special issue proposal to the Journal of Pension Economics and Finance, featuring original research articles that have policy implications for reforming the Social Security program. These submissions should be centered around academic research rather than policy advocacy, and paper proposals are due on May 1st. And if you have more questions about that and want more information, please get in touch with me sometime during the day, and I will provide you with that information. Okay, so before we start the first session, let's take a look at the results of our poll. So I think if we switch, okay, we have some respondents here, noted by, oh, they're still coming in, but we're going to kind of go ahead and see. Okay, so we can see that we already have a lot of importance placed on policymakers taking action within the next 3 years to achieve Social Security solvency. So no one thought that this was not important at all. And as the votes come in, the people find it more and more important that we take action. So I'm not sure we're going to get much higher than that at the end of the day, but it's obviously a select group of people who have come with us today to attend this program. Okay, let me advance one more slide. Okay, so then this next question was, if you had to choose between benefit reductions and tax increases in order to achieve Social Security solvency, what would be your optimal mix between the two? And you can see here that we're not all in agreement about how the program should be reformed. And in fact, there's some responses on all parts of the range here. And you know, there's some maybe a bit more weight on the left side and in the middle, but we see a significant range of possibilities that people have in mind when they're thinking about addressing the program. Okay, so the last question was, what do you most hope to learn from today's policy forum? So it looks like Social Security makes a prominent presence here, which I guess makes a lot of sense. But I also see policy, political solutions, and reforms highlighted here. So I think we will touch on all of those topics today. And so thank you for participating in that poll. We will, like I said, we will do a similar poll at the end of the day, and we'll be able to even compare some of the results. So I think I will go ahead and now introduce the first moderator of the first session, who will then introduce the panelists in the first session. So it is a true delight to introduce my co-author and friend, Gina Lee. Gina is currently a PhD student in the Department of Economics at Stanford, but in just about a month, assuming everything goes well, she will earn her PhD after defending her dissertation. And this summer, she will be joining the Federal Reserve Board as an economist in the microeconomic surveys section. Her research interests include health economics and public economics, and her job market paper investigated how healthcare utilization changes among low-income Medicare beneficiaries when they gain Medicaid coverage. She is also the co-author of a new study that Mark mentioned earlier, which investigates how some program changes resulting from the 1983 amendments to Social Security affected claiming behavior. And as Mark mentioned, that paper is available for you to peruse from the registration table. All right, well, I will hand it over to Gina, and thank you so much for moderating the session.
Well, thank you so much, Gopi, for that very generous introduction. And hello, everyone. I am delighted to kick off our policy forum today with our first panel, Social Security since the 1983 amendments. So before thinking about how we move forward, I thought we'd take a step back and think about the last major reform to the Social Security program to see what kind of lessons we can learn. Our two panelists today will help us set the stage through drawing parallels with the past and thinking through the consequences of these past reforms. So I'm delighted to first introduce Louise Shaner. She is the Robert S. Kerr Senior Fellow. Robert S. Kerr Senior Fellow in Economic Studies and Policy Director for the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. She previously served as a senior economist in the fiscal analysis section of the Research and Statistics Division at the Board of Governors of the Federal Reserve System. And she was also appointed as a Deputy Assistant Secretary for Economic Policy at the U.S. Department of Treasury in 1996, and served as a Senior Staff Economist of the Council of Economic Advisors in 1995 and 1996. Before joining the Fed, she was an economist at the Joint Committee on Taxation. Her research focuses on the federal and state and local fiscal policy, productivity measurement, demographic change, health policy, and other fiscal and macroeconomic issues. Her work has appeared in such outlets as the American Economic Review, Journal of Economic Perspectives, Brookings Papers on Economic Activity, Journal of Health Economics, and the National Tax Journal. She received her PhD in economics from Harvard University after earning an undergraduate degree in biology, also from Harvard. Second, I'm delighted to introduce Jay Song. He is an economist and senior advisor at the Office of the Inspector General as part of the Social Security Administration. He has been conducting research and analysis on all aspects of the Social Security program and program environment for the last 24 years. His primary research interests are in life cycle employment dynamics, earnings inequality and mobility, earnings risk, work and disincentives or incentives of the Social Security program, as well as immigration. He has authored and co-authored papers that have been published in the Social Security Bulletin, American Economic Review, Quarterly Journal of Economics, Journal of Econometrics, Journal of Political Economy, Econometrica, and other economics journals. He received his PhD in economics from the State University at the New York at Albany. So I hope you all give me a warm welcome to Dr. Shaner.
There they are. Great. Hi, thank you very much for that introduction. I'm delighted to be here to talk about Social Security. And again, as we said, we're going to look and see what we can learn about a past episode when we were worried about the sustainability of Social Security system. So since I'm the first slide for the first day, we thought we'd start off with some very basic facts about Social Security. So Social Security is a big program, as Mark talked about, and it provides important income support to almost 1 out of 5 Americans today. It is financed largely as a pay-as-you-go basis, which means that tax revenues come in from current workers, and those are used to finance the benefits of existing retirees. So it's goes right from tax revenues to benefits, except that in recent years, a lot of benefits have been financed by this trust fund that had been built up since 1983, and we'll talk about that. So why are we in this situation where we're looking at the sustainability of Social Security right now? It's basically because of population aging. So population aging has increased the ratio of retirees to workers. So if you had a system that was a pay-as-you-go system where you collected taxes from workers and you financed retirement benefits, and then the demographics change, so now you have more retirees, that system no longer works mathematically. Those taxes are not going to be sufficient to pay benefits, which is the situation we've been in recent years, which means you start to draw down on your trust fund and you start to deplete the trust fund. And as Mark noted, we now think the trust fund will be depleted sometime around 2034, plus or minus. And at that point, we're only going to have the incoming revenues. Those will be sufficient to pay about 80% of benefits. Okay? So Social Security faced this insolvency in the 1980s, the early 80s, leading to the major reforms that we're celebrating today, so we thought we'd talk about those. So So let's start at the background to the 1983 amendments. Let's start in 1979. In 1979, the actuaries projected that incomes would be greater than benefits for 30 years. They're like, we see that there's going to be problems down the road because we understand that fertility has fallen since the baby boom generation and we have some aging of the population, but we have plenty of time, right? We have 30 years where there's no issue at all. They did have a trust fund in 1979, but it was quite small. It covered about 20% of annual costs, so there wasn't a big cushion. And then I say recessions, but it's really like economic conditions changed in the early 80s. There was high inflation, real wages were low, there was 2 recessions, and that hurt the incoming tax revenues and boosted relative to the beneficiary costs, right? So all of a sudden, they saw that the assets were being depleted because incomes were lower than costs. And so they looked like within a few years, we're not gonna be able to fully pay benefits. So now let's go to that chart on the right. So this is the projection that they had right before the amendments. So the blue line is costs, and the orange line is income. These are both as a share of payroll. So the income is the tax revenues coming in, and the costs are the benefits going out. So you can see right at the beginning from like 1980, for like 7 years, that blue line is above the orange line, which means that costs were greater than income. So they were going to be using up the assets. They didn't have very many assets, and they're like, we are going to deplete the assets. But if you look a little further, you see that was temporary. And then income was going to be higher than costs for many, many years. So averaged over 25 years, even in 1982, they were like in good shape, right? It was just that there was a near-term economic conditions shifted that put the trust fund in bad shape. So what does that mean? So they only needed some small immediate changes to kind of get past those 7 years and then be okay for a while again. But what did they do? They did much more than that, right? They actually addressed the whole 75-year imbalances. So they did some things that helped in the short run, like they delayed COLAs for 6 months. That's the increase in benefits that comes from inflation, and inflation was very high in the 80s, so that actually raised a lot of revenue. They did I don't have time to go through all the list of what they did. One thing I do want to talk about is they increased the retirement age. Now this was in 1983. The retirement age for Social Security was 65, the full retirement age, and they increased it to 67, but they didn't do it immediately. They didn't even start raising the retirement age until 2000. So they did this big change that was not popular even the way they did it, but it didn't affect people immediately. It was really far down, and it was very gradual. So it started in 2000, it went up 2 months a year for 6 years, go from 65 to 66. There was a hiatus, and then it went up from 66 to 67, and we're just finished that transition now. So they did enough with all these different reforms to get back to 75-year solvency, which means they thought they would be able to pay benefits for 75 years according to their projections. Okay, so now let's compare the challenges in 1983 to the challenges today. So what I've plotted here are the imbalances. That's the difference between the income and the costs. So the blue line is what they were looking at in 1982, and the orange line is what we're looking at today. So you can see on the blue line, yeah, there's a few years where there's some deficits, but then they have years of surplus. We don't have that right now. We have deficits now. We're not fully through. We're about halfway through maybe the transition of the baby boomers going into retirement. So the imbalances are just growing, and then they're going to stay high because we don't think aging is a temporary phenomenon. We think that we're going to be, fertility is probably not going to go back to 3. In fact, some might argue that these are too optimistic because it's not really taking into account the declines in fertility we've seen in recent years. And so we have a population that's going to be permanently older and therefore permanent imbalances in the program. So you can see that the challenge is much bigger today. The 75-year imbalance is a number that the actuaries come up with that calculate, like, what would you have to do today if you started now and you would make a permanent change that would allow you to pay benefits for 75 years. So in 1982, it was somewhere between 0.8 and 1.8% of payroll. They had sort of 2 intermediate projections. And today, the intermediate projection is for it to be 3.8% of payroll. So it's at least double and maybe more than 4 times harder now than it was then. So what are the implications of this comparison? So the changes have to be larger and sooner than in 1983. We don't have the same kind of runway where we just have to get back a few years and then we have plenty of time to worry about solvency. We need to worry about solvency like now. Without the trust fund, this is something that people haven't talked about so much. Without a trust fund, so for the past, since 1983, we've had this big trust fund that's been built up because they made these changes that built up the trust fund. When you don't have a trust fund, even if you have long-term sustainability, solvency is very vulnerable to cyclical downturns, right? If we'd had the Great Recession without a trust fund, we could have been in trouble. But we had this trust fund, so like small, sort of temporary changes in incoming tax revenues don't matter. So what does that mean? It means that you could find yourself, if you don't build up another trust fund, you could find yourself having to cut benefits or raise taxes in the middle of a recession, which nobody wants to do. But how do we think about building up a trust fund? So building up a trust fund would require a current generation sort of to pay more, to pay a bunch of now to build up this trust fund. And it would say, not only do we have to get 75-year balance, but we have to do more than that because we have to get 75-year balance and build up this trust fund. And so it just makes the changes even larger. So the last thing I'm going to talk about is this concept about sort of using general revenues. So in Gulpy's poll, she said, well, is it taxes or is it benefit cuts? And when people talk about taxes for Social Security, what they usually mean is raising the payroll tax, right? When I talk about general revenues, I'm saying you could think about keeping the structure of the program pretty similar, which is it's financed by payroll taxes or taxes on benefits, and not sort of just part of the general budget. Using general revenues would just say, well, we spend it, everything else in the budget is financed by general revenues. It's just like, well, income taxes come in, we can use that. So there's many ways of thinking about bringing non-payroll tax revenues into the system. You could think about it as, like, maybe we could have a trust fund. The government says, I'm just going to put $1 trillion into a trust fund. Now Social Security has a trust fund. You could imagine that it says, here, we're going to make some changes, but we're going to guarantee that if there's ever a shortfall, general revenues would be used, right, to make sure that we can pay benefits. There's many ways of thinking about using general revenues. Now, what are the pros and what are the cons of using general revenues? So I think the probability that we're going to end up using general revenues, at least for some time, is really high because we have about 10 years until the assets are depleted. Maybe it will turn out differently than I think, but I think there's a pretty big probability that our political system is not going to get to any kind of real long-term reforms anytime soon, which means that we'll be very close to the date of asset depletion. We won't have any time to do much, and the easiest way to keep paying benefits is just to say, well, we'll just deficit finance it, basically. We'll just use general revenues when we'll borrow more. In the longer term, Social Security benefits replace about 40% of wages. So it's not like a huge amount. So there's not that much room for cutting. We talk about increasing the retirement age. One of the things that we know is that the increase in life expectancy has been very unequal across the income distribution. So people at the top end of the income distribution have received 5 years, or depending on what time period you're comparing, but a big increase in life expectancy, and people at the bottom have had none or very small increases. So generally increasing the retirement age seems like, well, we're living longer, we should do that, but it's not everybody is living longer, so it becomes difficult. The payroll tax base on which Social Security is focused has become an increasingly small share of GDP. And so thinking about using general revenues just allows a wider range of possibilities. It just opens and say, we can use an estate tax, you could use anything. And so you might end up having a more progressive or a more efficient or some kind of better source of financing than if you restrict it. And then again, in the long run, without this idea of using general revenues, I worry about no trust fund and economic downturns. So my last slide, okay. What are the cons of using general revenues? So I think the cons that most people would say is, well, you relieve pressure to actually address our long-run fiscal problems. If we did that, people say, oh, look at that gimmick. They said they solved Social Security finances, but all they did was borrow more. And so the trust fund sort of adds a degree of urgency for the long-run fiscal problem. Now, the same argument is made in favor of the debt ceiling, and we can see how well that's going. So it's not clear that you can use something like this to get political compromise, and maybe you can, but that's an open question. And you do, the argument to actually making those changes sooner is the sooner you act, the more generations you spread it over, the smaller the changes have to be, okay? The other thing that I think some people would worry about is going to something general revenues. I won't go through all the little bullets on the slide because I know I'm running out of time. is just this idea of whether or not it would undermine political support for the program, right? Right now, people sort of view Social Security as like, it's like a pension. I put my money in, I get my benefits out, politicians shouldn't touch it, it's my Social Security, I paid for it. You know, if it became like just like any other government program, it was financed by borrowing, I think people would worry that it would then be on the, you know, when we needed to cut, it would be sort of part of it, whereas now it's kind of been held outside of it. I'm not sure about the politics of that. I think as long as it stayed to have basically having payroll taxes and having benefits based on your wages, that wouldn't be a big issue, but I think that is a worry. So thank you very much.
SSA OIG, and but 15 years ago, actually, Joyce and I did some paper on revisiting 1983 reform, and 15 years later, I'm here. So, today I'm going to just talk about what has happened after 83 reform. That's my topic, and I'm going to kind of show you some numbers, actually, how we get here, and So actually, we heard that reform did many things, change, tax, and also change the coverage, also, gradual increase in full retirement age, and also change in delayed retirement credit. So full retirement age is basically the age at which 100% of PIA, the full benefit, is payable. And DLC actually raise, it's a kind of a bump up. Raise benefit amount for the months, for each month from FRA to age 70, in which no benefits are paid. So I'm going to use a little bit of acronym, sorry about that, but I've been in the government too long. So, basically this chart summarizes change in full retirement age and DLC, how those change affect the benefit amount. Basically, it cuts the benefit. So relative to 1936 code, 1936 code is the kind of a cohort, the pre-83 reform cohort, and 60 is when this change is fully phased in. So if you look at the claiming age of 70, about 8% reduction, 6% reduction in benefit amount. So, and then age 62, 10% point reduction in benefit amount. So every age, no matter where you claim the benefit amount is going to be reduced. So the rationale behind of this change, FRA and the DLC, was to encourage delay in benefit claiming. That was the kind of a rationale. And then try to do it in two different channels. Cut the benefit for the early claimant, and then increase the benefit bump up, DLC, for the late claimant. So that's the way that it was designed. And then those two rule changes reduce the benefit, and then the reduction of benefit is not uniform across different claiming age. So we would expect that the different reaction from different claiming age. So my next slide is basically then how have workers responded to these changes. So that's my next slide. So this one is kind of a pretty interesting, and basically what I'm doing over here is that frequency distribution of benefit claiming for all primary worker beneficiary from 62 to 70s. So the reason that I'm including 62 to 70 is I'm including only primary worker beneficiary, and then almost 100% of the primary worker beneficiary claim benefit between 62 and 70. So this is kind of a useful way to compare one cohort to another cohort. What happened to how they react to this change in terms of benefit claiming age. So you can see like a three distinct things. One is very high. The bunching at 62, almost like a 40, more than 40% for 1936 cohort, and then we can see like another kind of bunching at the full retirement age, and then it is gradually moving toward the right side as full retirement age goes up, and then you can see another kind of a little bunching over here at age 70. So this bunching at age 70 is because of DRC and at age 70. So there is no gain if you delay more than 70 years old. So that's probably why they retire at age 70. And then you can clearly see the impact of increase in full retirement age by looking at that, the sequential rightward movement of that peak, actually. So, then the next question I have over here is that, okay, so the people change their retirement age. So what happened to, so they delay the retirement age, we delay the retirement age, and then is the delay offset the benefit cut? That's my next topic. So in this graph, I basically kind of, calculate benefit as a percentage of PIA for actual, as of actual retirement age for birth cohort 1930 through 1950. So if you can look at this one, the y-axis basically indicate the benefit as a percentage of PIA, and then the x-axis is basically the year of birth. And as you can see, the benefit amount as a percentage of full benefit amount, that's declining until 1942 cohort. And then it starts increasing quite a bit. So I think this indicates something very important, actually. Of course, this is not a lifetime benefit. This is like a monthly benefit or a yearly benefit. So in order to look at the full lifetime benefit, you need to take into consider mortality as well as PIA amount, full benefit amount. But this, as you can see, that the percentage benefit that increase, and then also we know that the life expectancy for the younger cohort is increasing also. And then also the PIA, also, I don't have that cover here, that PIA, the average PIA also increased. So three things moving into the same direction. So in a way that, the lot of the cut that we kind of, designed earlier was offset by this behavior reaction from retirees. Actually, that's something that I think we can learn from this chart. And then next chart is, okay, then, people change their retirement age in response to the program rule change. Who changed the retirement age? Who kind of delayed the retirement? That's my next question. But of course, this is, the detailed analysis requires a lot more complicated model. But here I just kind of simply tabulate lifetime earnings by each benefit, each claiming age by 2-month interval. So lifetime earnings here, I'm calculating 21 through 60, annualize it, and then also the inflation adjusted, and the values, and then I kind of plot that, the average amount by the birth cohort. So 43, 44, 45, 46, 47, 48. Their full retirement age now is 66 years old. And then as you can see, the peak, we can see a big peak at 66 years. 66 years. So this indicates that, okay, a lot of people retire at full retirement age. They tend to be high wage earners. And I think they are more likely to be white-collar workers, and they are more likely to be like a professional, have a professional occupation. I found something like that from a pretty similar study that I did in the past. And so that's what happened. So looks like those people who have some more flexibility in terms of finance and health, they tend to kind of delay their retirement. So they are more flexible in a way. I think that's a kind of a lesson that we can learn from this chart. And the next one, so I'm going to kind of, this is pretty short, but I think we learned a couple of important things over here that, people, behavioral reaction actually kind of, offset some of the reduction. And people actually react to the program rule change. So we saw from here, and then, in 2000, retirement earnings test was eliminated, and then we saw the kind of a pretty kind of a, strong reaction from that change. So people tend to react to the kind of this kind of change. So And then also that some of the benefit was kind of offset, and then it is kind of moving into kind of the other direction. And another point that I want to make over here is that the workers with the high lifetime earning, they are more likely to be adjust their benefit claiming age. And I look at kind of also the AIME, annualized indexed monthly earning. That's kind of the Social Security when Social Security calculate the benefit amount. I think that's a kind of that's kind of a number that we usually calculate. And I look at that AIME too, and also the AIME also for those people who retire at full retirement age, they are the highest also. So if you kind of measure in one way or the other, you're going to get the kind of highest amount for the people with the people retired at full retirement age. And last two bullets, I didn't cover kind of anything during my presentation, but I think there was some impact on the work as well, and then also the Mark and Perry and myself, we did a little study maybe like almost 20 years ago or 15 years ago, and we look at the spillover to DI program because relative to OI, old age benefit, so full retirement age goes up, but disability benefits, they are still getting 100% PIA. So disability benefit become more generous. So the question is, do people claim more DI benefit? And I think we found some evidence of that spillover as well. So, that's my my presentation. Thank you.
Great. Well, thank you both so much. And before turning it over to the audience, I have some questions for the two of you. So first, Louise, you mentioned in your talk that at the time of the 83 amendments, the trust funds were expected to maintain solvency for at least 75 years. But that doesn't seem to be the case with most recent projections. Can you talk about, since 83, what kind of assumptions have changed or unexpected changes have happened in the meantime for that discrepancy?
Sure. So, I think it's important to realize that in 83, they did see the demographic transition coming. It's not like, oh, we didn't realize it. They saw it, they knew there were going to be imbalances. So the date is obviously a little bit earlier, but if you look, so the reason for that is mostly on the economic assumptions. So the Social Security actuaries actually produce this report every year that says, why are we different from 83? So you can see, so it's almost all economics. And I try to figure out which economic assumptions. So actually they did pretty well on GDP. If I look at the 1983 GDPs and actually what happened, they did DNP back then, they did pretty well. I think the biggest factor in the economics is the declining the taxable Social Security payroll is declining as a share of GDP. So you could get the top line right, but you're not going to get the tax base right. Why is that? The biggest reason is increasing inequality that they didn't foresee. So that for a given level of GDP, much more of the wages are outside of the system, above the cap, and that means that what's left is lower. The lower income have a higher replacement rate, so it's bad for the finances of the system. So I think that's the main thing. Other things like continuing healthcare cost growth is another, so that taxable wages people are getting more of their compensation in health benefits and less in taxable wages. But I think it's the declining, the inequality that is the biggest factor. But honestly, it's a long time to forecast for. They did not do terribly, really.
And the short-term forecasts were quite good, it seems, especially, yeah, thank you. And next for Jay, I want to follow up on these trends that you've shown in changes in claim behavior. And especially in the last 10 years, or the last decade, we've seen this quite large shift of folks a lot less likely to claim at age 62 and a lot more likely to delay beyond the full retirement age. Can you talk about the main drivers of this in the last decade?
Yeah. So I think I can see like a few. Actually, first one probably is that program rule change affects the generosity or benefit amount. I think that drives a little bit. And then also there are things called the signaling or institutional role of the retirement age, because 62, 65. That I think drives a little bit. And then also that some change in kind of job type, for example. So less physically demanding jobs are available for elderly workers, so they can kind of stay at work a little longer. And also that so they are healthier. So all these kind of things combined together, I think they are moving this kind of age to kind of a later age. I think that's the way that I can see it. Yeah.
Gotcha. Thank you. It's very helpful. And I also have questions for the two of you as well. So, knowing what we know now looking back to 83, were there changes or there components of 83 that you wish reforms that you wish had taken place, or were there changes that you think should have been part of the reform that were not instituted at the time?
So I'm not sure if there's one that would come to mind that sort of many people would have wanted. Is you could think about, they understood not only that we were having this demographic transition, but that they expected mortality to be declining over time and life expectancy to be increasing. And one thing you could have done is index something to some index of life expectancy. But as I said, I'm not sure. I wish they had done that, because that is across the board, and the life expectancy increases have been really unequal. So I'm not sure. I think that the reason I talked about general revenues is I'm not really sure that the solution to the imbalances of Social Security are within the structure of Social Security, which they wanted to keep at the time. It was a decision, and they thought about it, and they kept it. And so I'm not, sure that they should have sort of changed Social Security more in a way so we wouldn't have this problem.
Yeah, I think one of the things that I'm not so sure that because I'm not a policymaker, I never get involved. So one thing that 1983 and now is quite different time. And 83 when we had this amendment, whether we kind of knew what kind of a behavioral kind of a response would have around this time. So obviously that data telling us that basically that people kind of responded. And then their response can work in favor of the goal of the the reform, or the other side. So I think that that kind of a behavioral reaction, how that behavioral reaction would impact the reform. I think that's kind of another interesting thing that one can take a look at it actually. Yeah.
Right, essentially showing if the highest income folks are the ones who are most likely to
Right.
delay, then they're
Yeah.
drawing most from Social Security for a longer period of
Mhm.
time, right?
Sure, yeah. Yeah.
Right. Yeah. And so, just taking a step back, as we look at these reforms more broadly, what do you think are the major, key takeaways we can draw from these as we look forward towards potential future reforms?
I don't know. It's hard to know what the lessons are. We're in a really different time politically. This idea of sort of finding this middle ground. Tip O'Neill and Reagan. I mean, it's hard to imagine these days getting to that. And I think until we're in that position, it's hard to see us actually. I think that's what we need. If you're going to reform a program like Social Security, you sort of need bipartisan buy-in, or So I'm not sure. I mean, you saw that, this idea that something could work when you do it very far out, I think is an interesting one. And I think many of us would have expected that as the retirement age increase started, you would have seen, it would have been repealed. And it wasn't, and not only was it not repealed, but you didn't even see much outcry. So maybe that is a lesson, which is somehow you can do hard things if they're not that obvious, and they're very gradual, and so maybe that's a lesson. And I said we don't have as much runway, but the problem is getting worse over time. So you can imagine some combination again. So there is a lesson. You can imagine some combinations, some things that get us through a few years, and some things that take longer to kick in. And I feel like the final compromise will be something like that, to the extent it stays within the program. And if it doesn't, if it starts using general revenues, then then we're asking not about the program, but we're asking when are we going to address our long-term fiscal challenges more broadly. And I think it's important to remember that when you see the projections of the federal debt and deficits that CBO puts out and everybody, those assume that the benefits will continue to be paid despite the fact that the trust funds are depleted. So it's not as if using general revenues would make these projections worse. It's already implicitly assumed that general revenues are used.
And this feature of committing now to future changes is pretty more unique, no, among different types of legislation. Yeah.
I mean, I think so. If you think about how often we have tax reforms, so you do this big tax reform and you think you've committed, here's the tax law, and then you have another tax reform. So it's not usually things last that long. So there was something a little surprising about that. And maybe it was because we understood people were living longer and the program was, in bad shape and no one wanted to sort of undo it. But it was interesting that it worked.
Yeah. I think maybe this is kind of a slightly different perspective, but a couple weeks ago, I happened to see kind of a publication by SSA, basically looking at income of age 65 plus, and I was looking at the share of total income for elderly people. So I look at the Social Security, that's one, and then pension income, that's another, and then also the income from asset and also the earnings. But combining the earnings and the Social Security, there are I think more than like a 50%, almost like 60-some% as of 2012, and that has been going up quite a bit. I think that kind of indicates how important the program is actually, and then any change in the program affect benefit claiming, Social Security income, and then it also impact earnings as well. So any kind of change, 84 reform, 83 reform, or upcoming reform, that will kind of have a kind of a huge impact on the income of elderly people, and that's kind of how important it is, I think.
Yeah, absolutely. All right, I have a lot more questions, as you can see on the sheet of paper, but I think I should open it up to the audience first. All right. I believe there are microphones coming around. Yeah.
Would you like to call
Sir.
So I think the goal would be to fund Social Security, might as well throw in Medicare in there, and not dampen GDP and not stoke inflation. And I'm wondering if reducing the estate tax exclusion from nearly 26 million to half that and dedicating revenues from that to the trust fund would accomplish the trifecta of not dampening GDP, not stoking inflation, and funding both Social Security and Medicare.
I'll take it. So I think that some people would argue that the estate tax would dampen GDP because it's an incentive to you want to pass on to your heirs and would change savings. I don't actually think it would be a big deal. I think that is one of the reasons that I want to broaden the discussion towards other kinds of things that could affect, to put Social Security in a solvent position that doesn't necessarily change the program itself. In terms of inflation, remember, as I said in terms of the projections, this idea that Social Security benefits are going to continue to be paid is already in the deficit projections. It's already in current. So like if we actually cut benefits by 20%, that would have like a recessionary impact and a deflationary impact. So I'm not really worried about Social Security being a source of inflation. But you want to choose among tax revenues that aren't, that have good incentive effects, and you might think, well, let's make the estate tax a little higher and capture more estates. I think that's a reasonable thing.
Hi. The data refresh on what has happened is really useful. Sometimes it's not about projections, it's about history. One quick question, hopefully I get a quick reaction, and then I'll go into more in depth. I think when most people hear the comment that the system will be insolvent, they assume that means nothing's going to be paid. But in fact, the way we're using the term insolvency today is 80% of benefits, correct? Okay, so I just want to verify that because I think that that's interesting for most people, particularly younger people who say, you're insolvent, and they say it won't be there. Has there been any work that you've done in Social Security or anybody else looking at what the effect might be, what I'll call work elasticity here might be, if you raise the payroll tax, if you double the payroll tax on the decision for that group of people, let's say, that are continuing to work between the ages of 65 and 70, and therefore paying money into the system, what would their response be to that? Might not their response be to say, I don't need to work. They won't claim until 70, but they won't pay into the system from their income between those ages. Any analysis of that?
I think I have seen some, but I don't have a clear kind of summary of what they did, top of my head. But definitely I'll take a look at it a little bit more when I come back. But definitely there was some effort to kind of tease out the elasticity of tax on work or the wage, and I think it kind of varies by study, probably varies by assumption and population they study and things like that. So, but definitely there was some study, and I think in this context or in some related context. Yeah.
Can I follow up?
Yes,
So
please.
a number of things about your question. So first of all, the 80%. So one of the things that's super interesting is we don't actually know, just like on the debt ceiling, when it binds, we don't know what Treasury is going to do and how it's going to keep within it. We don't actually have a way of saying everybody's benefits are going to be cut or Social Security. Like, it's just unclear in the law. So like Social Security won't tell you what they'll do because they don't know, because there's no legal basis for them to figure out how they don't spend the money. They've got the law says here's your benefit. On the people thinking, oh, it's all going to be gone, everybody says that, oh, it's not going to be there for me, but it's not at all clear it's showing up, oh, well, I'm going to save for my retirement because I'm not going to have Social Security. It's just like, well, In terms of the payroll tax, so I think people do worry that if you solved all of it on the payroll tax, that you would have a big effect on incentives for labor supply. And people have different views on those. I have seen proposals to say, imagine we increase the payroll tax, but we wanted to have incentives for people to actually keep working, not just not claim. And therefore, maybe after you've paid 35 years of payroll taxes, you could now work without, there could be some things that say, we're not going to increase the payroll tax for people who are already X, because we want to keep the incentive for them to stay in the labor force.
Yeah, so my question builds on one that Gina asked, which is, like, what lessons can we take from this historical experience for future? And specifically, Jay, the discussion of changes in the full retirement age and the behavioral response to that is interesting. So I just wanted to get a sense, if you could imagine having a very simplistic assumption that if you change the full retirement age, that the only thing that changes in people's response is people who would have previously claimed at the original full retirement age shift to the new retirement age, and all of the behavior stays the same. So you could imagine the budgetary impact of that. But then there's all the other changes. Then people may, in response to that, decide to start delaying till age 70, or they may be more likely to start at age 62, or they may go into DI because it's a longer period of time before they. So I just want to get a sense of, like, how big are the behavioral responses in eroding the impact that changes in the full retirement age would have if people only changed full retirement age claiming behavior. Do you have any kind of sense of how large that is?
So how large? So so how what's the kind of our kind of a measure? So it's that question, but I think it's pretty big. As you can see, like the full retirement, about 10% of people they delay kind of a 2 months or a year, and then also that at 62 again, people can also change it quite a bit. And DRC, when DRC ends 70, I think 1950 cohort, we have almost like 7 or 8 or 9% on the bunching at age 70. So that kind of shows that reactions are pretty big. But we cannot say this is all coming from this the reform. But I think it could went through a different channel, of course. And but I think that as kind of people get, as kind of time goes on, and people get healthier, and they have a kind of a comparable skill level to the younger cohort, then the reaction could be much bigger in the later kind of years. So I don't think it's going to be getting smaller, but it may get larger. So it's hard to say that how much, but I can say that this is kind of big enough and important enough to kind of for policymakers to pay attention to it, I think.
Jay, I want to follow up on that one, just on that question, because you have a really good point. You had mentioned in your comments also the institutional changes that could have an impact. And so I think it's important for historical context that people understand here. A little over 10 years ago, when someone went to Social Security, talked to a claims rep, and they said, I'm 62, when should I take benefits?
Right, yeah.
The agency said, take it today at 62, because you'll be ahead for the next 14 years.
Yeah.
Not telling them that at age 76, you'll then be behind for the rest of your life.
Yeah.
And the agency was using a break-even analysis. Right. We got rid of that, Andrew and I, at Social Security under Commissioner Astrew, and now it's a personal decision. And they get a one-pager that has a nice little bar chart that says if you got $1,000 at your full retirement age, you're now getting $720 at age 62 or $1,240 at age 70. And that chart, they look at it and go, wait, what does this mean? Because people still hear of the early eligibility age, and who wants to be late for getting your benefits? They still don't understand the formula or how it works. A lot of people don't. The modal age of claiming is still 62. So what you're seeing now is a change in the signaling and the messaging. Like when I walked into the agency over 10 years ago, we had posters everywhere, 62, 65, 70. That was the poster, which sent the signal that 62 was the first age you should start claiming. And now we're making it a personal decision and talking to people. So that's having an effect. And then the other thing I wanted to point out about your research is you're showing that those who are claiming later tend to be those that can afford to claim later. And I think as we start talking about raising the retirement age as a policy option, we need to keep in mind that for those who cannot afford to delay claiming, those reduction factors will be larger, and that means that benefit at 62 will be less meaningful. So we need to keep that in mind when we're talking about reform options.
Yeah. Great point.
Hi, thank you. And I'm wondering, so we know what they did in 1983. Do we know what they considered doing and didn't do, and why?
I'm trying to remember so the commission itself did not recommend the increase in the retirement age. They considered it, but could not get the votes on the commission for it. And so it was like I looked up the report. I wouldn't have known that prior to this week. It was like in an appendix as like one part of the recommendations. And I think the other part were more progressive and wanted more tax increases. So one of the things that people look back and say, and look at the reform on, is it was actually quite heavy on benefit cuts. So the retirement age, the increasing the tax rate on self-employment, the retirement age, getting rid of the COLA actually mattered. And so I think the more progressive and wanted more tax financing. But I don't know what else. I don't know if anybody else does.
I'll ask.
Yes.
Well, so we were talking a bit earlier about how you could have changed the benefit structure by just reducing benefits, and maybe you change the slope a little bit because you reduce them less at age 70 without changing the retirement age, or you could have increased the retirement age. And economically, those are the same exact thing, but they have a different effect in terms of how the benefit schedule is framed. And I'd be curious to hear your thoughts on whether that is another lesson we can take from 1983, or what might have happened differently if instead of changing the retirement age, we were tweaking the schedule without framing it in that way.
Yeah, I think then, back to kind of Jason's comment. So we can change the schedule without changing the retirement age. That's doable. Then I think that the signaling and the institutional role of the kind of the retirement age, that may not kind of work there. So I think that can be. I mean, in theory, that can be doable, but.
So I think there's a question about the importance of these focal points. But as you say, we could have done it the same way, but we could have also done it in a more progressive fashion, right? Which is that you sort of get the average retirement cut, because of retirement age is just a benefit cut, but done in a more progressive fashion. I think one of the questions that I have sort of going, if we were to keep going down this road, and I think something that hasn't come up yet is that, so clearly you can cut benefits at the top a lot. So if you're worried about the progressivity of the system, and that is something I would be in favor for. But I think one worry again is back to the political support for the program. That losing the universality of the program is something that we're all in it together. Or if it becomes, it's already less of a good deal for like higher income people. And so the thing with the retirement age is, again, it's an institution. It's something we're all going through. We're all together, and there's something nice about that. And maybe it has increased the labor force participation. And when people ask, like, what is the best thing I should do for retirement? Like, keeping people in the labor force, not just like delaying claiming, but keeping people working is hugely important. So then there's a question on whether or not we should think about the 62, right? And whether or not, like, I mean, we're worried that the 62, there are people who retire who really can't work, but, you know, perhaps another way of, you know, is like, let's maybe not allow people to retire at 62, to claim at 62, but I don't know.
This question.
Mark wants to be like he's
Oh.
got a big.
All right.
Okay, here you are. Here's the microphone. Yep. Thanks. I think it's helpful to think about what was going on before 1983 a little deeper, because Congress, either every 2 or every 4 years, had to raise the tax. And what it really became was more of an annoyance, because there was immense political pressure to maintain the program because it was popular, and this was not something that, as a member of Congress, you wanted to vote against. Mm-hmm. So partly this is a compromise from relieve us of political pressure. This was a tremendous tax increase. So when you compare it to the previous tax increases, which were all relatively small compared to this tax increase, this is a huge tax increase. I find it frustrating that people act as if that tax rate now becomes stone when it wasn't stone before 1983. The program was stone, the tax rate wasn't. And that tax rate increase, which was huge, now by comparison, as you were mentioning, had we corrected this back in the 90s or in 2000 when we understood the effect of inequality, that would have been tiny. Tiny not only compared to 1983, but kind of tiny compared to some of the pre-1983 tax increases, which in a couple of years had to be very big. So is there something wrong about us having moved to this concept that this program has to be all-seeing, omnipotent, and away from what was the reality for the previous 50 years of the program? The previous 50 years was, you don't know the future for 75 years.
Well, so I think what's interesting is that I sort of think about around 1983 as when the program sort of matured in a way, and then was kind of very constant since then. I think part of the reason, it's been a long time, the program has been pretty constant, because remember, for a long time, the benefits were not indexed. So it was also something that politicians could give away all the time. We're going to raise the Social Security benefit, right? And then it got indexed, but they made a mistake, and so it was over-indexed, so then they had to go fix the indexation. And so really until like around 1980 or 1979, it wasn't this kind of like program that was on autopilot. So then everything was indexed, and so the program was on autopilot, and I think that's what happened is, and they had surpluses because they had arranged that. So there was no real pressure on that. And then you're at a situation where you've had the same program for 40 years. So that's where it gets to be, well, you can't touch that. No one's touched it for 40 years. Not exactly, but basically. So, and then just, these days, just this idea of now coming to compromise on tax increases, like maybe we'll get there, but it's hard to see.
Yes.
Thanks. This has been super interesting. I've learned a lot. So one thing that I think is important to point out about the amendments, and I'm curious if you all agree, is that the changes were all uniform for everyone. In other words, on paper they were uniform, right? For example, the increase in the full retirement age, 2 years for everybody. The increase in the payroll tax rate, the same for everybody. One thing that I just want to flag, and we're going to be talking about this later today, is a lot of the things that think about getting Social Security on a better financial footing are not of that variety. They were very much not of that variety. And so one thing that hasn't come up at all in the discussion, I don't think, unless I spaced out and missed it, which is really first order about this program, is the benefit formula. So the 90% of your first basically $1,000 a month in earnings it replaces, then 32% of your next $4,000 a month, and then 15% of your next $5,000 a month if you're fortunate enough to, let's say, have average earnings of $10,000 a month or something. So it's a much higher replacement rate. And the tricky thing is, when we think about reforming, I just want to hear your comment on the following, but when we think about reforming Social Security, one thing that's very challenging is that for 1 in 5 or 1 in 4, even 1 in 3 elderly Americans, Social Security is all they've got. That's it. Like, that is their income, period. But that's partly, potentially, it's hard to know, it's one of these like hard to know, that's partly an artifact of the program's benefit formula. If you know that you're gonna get 90% of your earnings when you retire, it doesn't make any sense to save. Do you know, like, so I'm just curious about, as we think about this, we're kind of in this pickle where people, forward-looking people, optimizing subject to this program's rules, shouldn't save. Do you know, because you're gonna get, if you're gonna get 90% of your earnings and it's taxed lower than your earnings, you're actually just, you don't have to save at all. But because they don't save at all, do you know what I mean? You can't really think about tweaking the program. So it's a little bit of a, I don't know, I'm just curious, this 90-32-15, the like, how to think about that, because 83 is all same change for every person, every taxpayer, every recipient on paper. Thoughts on that?
Yeah, great point, Mark. But yeah, and economists typically kind of assume that we kind of forward-looking and looking at what's going to happen in the future and then make a decision today. That's a kind of typical way that we think. But so in that framework, yeah, obviously that the generosity of 90%, that's kind of what Mark described. I think that's totally doable. And the question is that. So this is kind of not a welfare program. This is kind of an entitlement program, and so in that context, okay, so you earn and that much, and you worked it, and then that's what you earn, and that's the kind of the way that the system was designed, and I guess how that impact lower kind of end of the earnings people in the earnings distribution their behavior. I think that's something that we probably need to study a little bit, and I think probably there are kind of useful kind of a data source available out there, and then I think one can kind of spend some time to kind of study about how that happened in the end of the tail side of earnings distribution versus in the middle and the top side. I think that's an important kind of area to kind of dig into in the future, I think.
So Social Security, you might say so people get Social Security and it's necessarily, and people say it's a large share of their income, so it reduces poverty. And you can't say that because it could be that it's just replacing savings. But I think there has been work showing that it actually causally reduce poverty. One of the reasons for Social Security is people don't save, and people who have limited means don't necessarily save. So the idea that we should be cutting benefits for really low-income people, well, so when you consider the change in the 90, then that's what you're implicitly. So, fine, but right. Oh, I see. Wait.
I'm not suggesting let's cut it and hope they save more.
Okay. Well, I mean, we can cut it for higher income people. As you say, we already have bed points, so like it's not that difficult conceptually. It's not as if everybody gets 40%. Like we've never had that universality. So we do have the ability to do that. And then I think it's just a matter of, how much do you want to push that as the way of sort of getting higher income people to contribute more, or do you want to just go broader and find different ways that I also think would be sort of progressive that maybe wouldn't make this a really bad program for high income people who get nothing? That's what I worry about.
All right, I believe we have time for one final question. Or
something.
Yes.
What impact would the legalization of undocumented immigrants have on the scope of the problem and potential options for solutions?
I kind of some time ago I looked at IRCA books. What happened to them after they've been legalized. So so I think they kind of I think it's called immigration kind of a studies. They call it catch-up or something like that. I think something like that happened quite a bit. So obviously, there could be some other sources, but but I think overall, my number was kind of they are still kind of a majority of them, or kind of the bottom half of the kind of earnings distribution. That's where they were kind of located. But I think there could be something, but I'm not in a position to say anything about the immigrations. But yeah, so I have seen something like what has happened to them, and I think the catch-up was happening with those folks. Actually, that's what I can say. Yeah.
Well, thank you all so much, and thank you to our panelists. Can you please join me in thanking our panelists for our session? Thank you.
Hello, everyone. I hope you had a good break and enjoyed the first session. I'm going to get things started for the second session of the day. So I'm very pleased to introduce my friend and colleague, David Molitor. David is an associate professor of finance and economics at the Gies College of Business at the University of Illinois at Urbana-Champaign. He's also a research associate at the National Bureau of Economic Research. He completed his PhD in economics at MIT in 2012 and started his career as a postdoctoral fellow right here at CEPR during the 2012-13 academic year. And it was through that I got to know David quite well, and I'm really pleased that he's visiting CEPR this year as a visiting associate professor. His research explores how location and the environment shape health and healthcare delivery in the United States and has been published in a variety of leading academic journals. He has won numerous awards that are so numerous that I'm not going to list them all right now. And he has been featured in major media outlets. And I'm going to hand it over to David to introduce the panel. So thank you very much, David.
Thanks, Gilbert. Well, I just want to say thanks for including me as a, just in the day today. This is fascinating. I'm a health economist, and so kind of adjacent to Social Security, I think a lot about aging, but I'm learning a ton. So I just want to introduce this next session, the importance of Social Security across the population, kind of where it fits into today's agenda. So the session that we just came out of kind of set the background for Social Security's role in the United States, in particular since 1983, and kind of thinking about what impact Social Security has on average in the United States. But as we've already begun to discuss, there are large differences across individuals in their earnings trajectories, in their life expectancy, in their family structure, and this means that Social Security is more beneficial for some groups than for others, and not always in the ways we might expect or hope. So in this session, we're going to examine the issue of redistribution in Social Security, as understanding this is crucial for thinking about future reforms. One of the things that I've learned from health economics is that before you can treat a problem, you have to diagnose it. So this session is going to be a little bit on diagnoses and setting the stage for thinking about how to most effectively reform the program. And so I'm very much looking forward to hearing on these issues from two preeminent experts who will be joining me today. So I will introduce them in the order that they'll give their remarks, and then they'll come up and give remarks, and we'll have a conversation. So our first panelist is Karen Smith. Karen is an internationally recognized expert in microsimulation and a senior fellow in the Income and Benefits Policy Center at the Urban Institute. So Karen has developed microsimulation models for evaluating Social Security, pensions, taxation, wealth and savings, labor supply, charitable giving, health expenditures, student aid, welfare reform. Probably be easier to say what she hasn't looked at for nearly 40 years. Some specific microsimulation models she's developed have included the Social Security Administration's modeling income in the near term and policy simulation model, as well as Urban's dynamic simulation of income. Karen has written extensively on demographic and economic trends and has contributed to numerous books and scholarly journal articles. She's also served on advisory panels for numerous organizations, including the National Academy of Sciences, and Karen holds dual degrees in economics and computer science from the University of Michigan, so go blue. Our second speaker is William Spriggs, who is a professor and former chair of the Department of Economics at Howard University. He's also chief economist at the AFL-CIO trade union, where he chairs the Economic Policy Working Group of the Trade Union Advisory Committee to the OECD. So Bill has extensive experience in leading economic policy, development, and research, including serving as Assistant Secretary for the Office of Policy at the U.S. Department of Labor from 2009 to 2012. And he's had senior roles with the Economic Policy Institute and numerous other government agencies. Bill is a member of several advisory boards, including the National Bureau of Economic Research and the National Academy of Social Insurance, where he received the Robert M. Ball Award for Outstanding Achievement in Social Insurance. And he holds a master's and PhD from the University of Wisconsin-Madison, so go Badgers. And I'm from the University of Illinois, so we're very well represented Midwest and Big Ten. Anyway, I want to welcome Karen to give some opening remarks.
Hi, thanks for having me. So this chart shows the progression of family income of people age 65 and older and poverty rates among the same population. So the blue line is showing a sharp decline in poverty rates among aged individuals. And this is happening largely because earnings are rising. But I want to highlight a couple of things about this. You got a sharp decline in the poverty rate because Social Security coverage was rising. You have more women working and contributing to their own Social Security benefits. But I think important in this is that, when Social Security was passed, it was passed in order to alleviate poverty among the aged population. And clearly this chart shows that while, yes, poverty rates of the aged have been declining, it's really kind of plateaued at about 10%. So we have not eliminated aged poverty. The other thing that's important about income of older people is that it's very unequally distributed. This chart shows the retirement incomes at age 70 for different cohorts. So the bars on the left are showing the pre-boomers, the bars on the right are showing millennials. And what you see is that, first of all, yes, median per capita incomes are rising. This is at age 70. But the income of the top 20 percentile is about 10 times that of the bottom percentile, and about 3 times. Oh, so I did. Sorry about that. It's not advancing. There you go. Oh, okay. Okay, sorry about that. So the top quintile, the income of the top quintile is about 10 times that of the bottom quintile and about 3 times that of the median quintile. The other thing that's important to this is if you look at the growth rate of the income at the bottom quintile, it's pretty flat. So most of the rise in incomes are happening at the top of the income distribution. Okay. And Social Security is a really important source of income, especially for the people in the bottom income percentile. So what I'm showing here in the blue bars is the share of Social Security percent of total income. So for people in the bottom quintile, it makes up about 85% of total income for people for pre-boomers. And it makes up about 91% for the millennials. So Social Security is an important share of income, but it's also rising in terms of its importance. Now, why is that? Well, Social Security tax rates have been going up. So when you increase tax rate, I can save less. So yes, this is forced savings. Social Security is giving you forced savings. Also, Social Security, the tax max has been rising. So what that means is Social Security is covering more of your total earnings. So we do get a rising share of total income coming from Social Security. But Social Security is more important for certain subgroups. It's more important for people who are unmarried. It's more important for Blacks and Hispanic people. And it's more important for women. So this chart shows the present value of Social Security benefits by lifetime earnings quintile. The top bar shows the top 20% of earners, so the top quintile, and the blue bar shows the bottom quintile. So first of all, the Social Security provides a lot of lifetime benefits, so it's about $400,000 of lifetime benefits for people at in the top quintile, and about $1,500 or $150,000 for the bottom quintile. So the top quintile has about 2.5 times that lifetime income, lifetime benefits is the bottom quintile, much more equal than the earnings or the lifetime incomes or the income. So it's Social Security is equalizing. But you see that the slope of those lines are diverging. So by the time you get for people born in 2000, that difference is about 3.2 times. The top quintile is about 3.2 times that of the bottom. Part of the reason for the rise is that people are living longer, and there's rising real earnings. But yes, Social Security is progressive. So this shows the ratio of lifetime benefits to lifetime taxes. And for people in the bottom quintile, Social Security replaces about 1.8, or the ratio of benefits to taxes is 1.8 of their earnings, so of their benefits. So what does that mean? It means that you're getting more in benefits, lifetime benefits, than you paid in taxes. And for the top quintile, that's the black line, it's about 0.7. So they're getting less in benefits than they paid in taxes. The other thing to notice is this ratio is slightly rising over time. This reflects the increasing life expectancy. So as people in later cohorts live longer, Social Security is promising them more and more benefits. Okay. So this is looking at the replacement rate. A lot of financial advisors say, what do I need to save? What do I need in retirement? And a rule of thumb is you need 75% of your pre-retirement income in order to have adequate retirement adequacy. So this looks at the share of people in different cohorts who fail to meet that 75% threshold. So for pre-boomers, those are people born in 1936 to 1945, about 23% of pre-boomers fail to meet that 75% adequacy. And that rises to 38% by the time you talk about millennials. Now, why is this? Well, there's an increase in the Social Security full retirement age. That's a benefit cut. It just is a benefit cut. And so people in later cohorts are simply going to get less out of the program than they paid in. I want to highlight here, though, that these orange bars. The orange bar says, what if Social Security cannot pay what it's been promised to pay? And we have a 20% benefit cut. This shows this very sharp rise then in the share of people who have inadequate income if there is a benefit cut. That's my last slide.
So thank you for having me, and I'm very happy to be here today. I'm going to talk about a part of Social Security that people don't talk about enough. It's just a reminder that this is not OA, it's the Old Age Survivors Disability Insurance Program, and it's important to remember the insurance component of Social Security. So the projections for differences in dependency on Social Security income for the older workers, I'm going to start with them, but talk about the fact that this is an insurance program, is that the Black population will be more dependent. There are a couple of reasons for that. The income mobility data that Chetty and his cohorts have looked at show that we will eventually have some convergence between whites and Hispanics. We will never reach convergence between whites and Blacks or whites and Native Americans. And there's a huge wealth gap. You have to remember that in 2008, during the Great Recession, that actually Black wealth loss was so rapid that if you did a projection, it looked like Black wealth was going to go to zero somewhere around 2013, 2014. Fortunately, that didn't happen. So the real difference is in annuitized assets that blacks have far less access to. And so that becomes an important dimension of thinking about some of the equity issues when you look across this. You'll notice that access to pension funds is not the gap. Black workers have, since the 1940s, been far more likely than whites to be members of unions. That advantage has declined dramatically as we continue to attack Americans' ability to form unions. But it's still the case that blacks hold a tiny edge in terms of union density. So it really is about this huge wealth gap, and that's what makes the black population more dependent. So I'm going to talk about some of the key disparities that were ingrained back in 1980 and have been exacerbated since then. And these are things that going forward are going to leave huge disparities in how the program functions. One was a very mysterious thing that happened, and that was, without debate, a change was put in to take surviving children, and instead of surviving children getting a benefit until they were 21, the benefit was cut at age 18. It was 21 or you complete college. And then that was erased. It went to 18. This had a huge disparate impact for blacks because the life expectancy for blacks is shorter. That doesn't mean black people don't benefit from Social Security. It is an insurance program. And so black children benefit, and there are a lot of black children who get Social Security benefits. Before 1980, if you look at trajectories for the United States, it looked like we were going to erase poverty. I would have, and I should have brought my famous Sheldon Danziger chart. If you did a straight line trajectory before 1980, it looked like growing prosperity, ending poverty, and somewhere around 1990 or early 1990, we wouldn't have poor people because the nation was becoming wealthier. That reversed. No one in 1980 could have fully anticipated the size and the magnitude of that reversal. This has clear impacts for racial disparities. And then the survivor's benefit when you are married always had a built-in kind of penalty for equal earning couples. The program envisioned that a high earning male was supporting a woman who was doing a lot of caregiving, and the formula was meant to be fair to the caregiver, not envisioning that there were couples who both earned the same amount of money, but that is what is typical in black families. So here's a key chart that people forget when they think about Social Security because there's the whole issue of the survivor's benefits. So the gray line at the top, these are children who have lost a parent. Close to 1 in 10 black children before they reach age 17 no longer have both parents. One of them has died. During COVID, this changed dramatically because COVID really was a disease of the working people. If you look at it among whites, it was a disease of the elderly because they were disproportionately in confined space. But when you look at it for every other racial group, this was a disease of workers, and mostly for black and for Native Americans. And so when you look at what happened, is there was a dramatic increase, significant increase in the number of black children under age 18 who lost a parent. And so when people talk about reforms and changing the formula, they have to remember there's another set of people who benefit from Social Security. This isn't just an old age program. For low earners, this is vital because, of course, their earnings are not going to generate savings. This is why it's insurance. Cutting off the benefit at 18 instead of 21 has real impacts in the black community. Low-income black people go to college far more than any other low-income group other than Native Americans. So the result is that black children and Native American children, when they apply to college, are far more likely to be coming from households where the expected contribution from their parents is 0. And this dominates among Black students. Cutting them off from the Social Security benefit at age 18 exacerbates this. And studies done of what happened at that cutoff point in the 80s showed a significant drop in college enrollment, particularly for the children who had been the beneficiaries, and so therefore had a disparate impact on Black college enrollment in the 1980s. And then comes the wealth gap. Black children who go to college are from households that have significantly less wealth than is true for whites. So these are parental contributions to help out the kids. I've circled the part where it's to help out kids in education, and you notice that the median Black household that is helping out their kids with college has a tiny bit of wealth compared to white families that are helping out their kids with education. Again, this creates a huge disparity when it comes to college attainment, the completing of college. So this cutting off kids as they reach college age has a very significant impact on the disproportionate share of kids who do need the Social Security benefit in Black families. The other thing was, we constantly hear we're living longer, that's what challenges the program. The we is a royal we because we are not living longer. So this is really a phenomenon at the top of the income distribution. And as you saw in Karen's chart, what is really happening is that high income individuals are really getting more benefits because they are living longer. And the reason for the cap was the idea that we cap benefits, but that's capping annual benefits, not capping lifetime benefits. So when everybody was living about the same, well, that seemed fair. But now the lifetime benefits, as Karen's chart pointed out, are growing for the high income people because they're the ones who are living longer. So when we have these conversations about we're living longer, we're not living longer, and a lot of discussions about formulas and, let's make people retire later or because we're not living longer. And so this has real distributional effects, particularly for that part of the distribution where people live shorter, and Blacks and Native Americans have the shortest life expectancies. We've made tremendous gains in Black life expectancy since the 1980s, but that plateaued, of course, during the COVID era when Black life expectancy plummeted for the reasons I showed you in the chart. It was a disease among working people. The other thing is the march to income inequality stopped. And this was true nationally and all trends, but it was particularly true of the advancement we had seen in the Black community towards convergence with white income. This is for men, and so the gap was way bigger. Being down means the gap is bigger. Going up means we're closing the gap. So the gap at the median was closing, the gap even for the 90th percentile was closing, and then it diverges. And then there's some extra dots on there because the other phenomena that has increased since the 1980s that wasn't something you could have predicted was the massive increase in zero earnings among men. This has a big change in the way you look at the advances of Black income compared to white income because the disproportionate rise in zero earnings is harder on Black men than white men. Part of that is the result of mass incarceration, which nobody in 1980 could have seen the unbelievable skyrocketing of our prison population, and no one could have predicted at that point its disparate impact on Black workers. So suddenly you had reinstituted, after we closed the gap on coverage, we reinstituted a big chunk of Black workers who don't get Social Security coverage. Because even though prisoners work, that pay is not in the Social Security tax system. Those are zero earnings among prime age workers. So that has a key impact when you think about the issue of of the equality of the system, particularly, again, because it's people at the top who aren't paying compared to their lifetime benefit earnings, which is the other way we should be thinking about things. And when you think about, who's making the cap, I didn't do it for the cap, but just to give you a general idea. So close to 22.5% of white men make over $100,000. So this is in the neighborhood of the people who are near the top of the cap. And you see black women and black men do not that often make anywhere near the cap for Social Security taxes. This has a real political dimension because this is real for white men that you're near the cap. It's not so real for anybody else. The other thing that was in the formula, as I mentioned, which was meant to be a way to address inequality between men and women because caregiving by women, was to address this from the perspective as Social Security was designed. Social Security is really designed as a family program, and it is designed to protect the income of the family from the perspective of what can happen to me as a worker. As a worker, I may unfortunately become disabled and no longer be able to support my family, so I'm insuring the family against the unfortunate thing I become disabled. I may unfortunately die when my family thought I was still going to be making money and helping out, or I could reach old age, hooray, and I'm blessed, I get to live long, but I'm not competitive in the labor market anymore. And so it's designed to protect the family, and the formula benefited the notion that, well, the typical family has this high-earning male, a woman who's doing caregiving, and then we will protect the survivor benefit for the non-working spouse. Except for black couples, that's not the typical family. The typical family are two earners who make about the same thing. So black families who reach these income levels, the same income level as a white family, are doing it by having two people work, but the formula gives you more benefits, ironically, if one of you had made all the money and the other one didn't. You actually end up as a couple receiving more money that way than if both of you earn the same amount. This was always wrong compared to what was true for black families. And we haven't figured out a way to fix that. That is a gap going forward. So going forward, we have a lot of challenges because inequality rose in ways and in magnitudes that we had not anticipated. And those increases clearly were related to the increase in racial inequality, which stalled and in some ways were exacerbated by other policy choices we made, like mass incarceration, the decline of union density, which was dramatic since the 1980s. So fewer workers today get a defined benefit pension to supplement their Social Security. And despite what many people may think, there are not that many financial companies who are desperate to get as clients low-income workers who have infrequent payments, infrequent checks. They're not running after them and saying, oh, we'd love to give you a retirement plan. And if they did, it would be with fees much bigger than what Social Security represents, right? Social Security is almost free when you think of the administrative cost. When you think of what that private company would be doing with these low savers, it would be almost eating up their savings. So those are the differences. I hope we always keep in mind when you change benefit formulas, you're changing disability benefits. 1 in 10 black kids is getting a survivor's check, but a higher share of black kids are getting a check because their parent has entered into the disability program. Some of this gets masked because if you're on disability and you live long enough to reach retirement age, you then get shown in the system as in the old age program. We don't see you as a separate set of people. So I think that's one reason why people get confused about the importance of the insurance part, because the data gets reported to you to mask some of that importance.
Well, thanks, Karen. Thanks, Bill, for those comments. I have a few questions, things that we can, for discussion, and I want to start by building on a point you made, Bill, which is to think about Social Security and its role as providing insurance. You know, we're talking about redistribution from one group to another, and redistribution is at the core of what insurance does. You know, moving, kind of taking consumption from states of the world where you have plenty to a state of the world in which there's a loss, and some of that happens from across the life cycle, saving for a future date, but some of it happens just across people based on what happens to them. And so Social Security is insurance against the risk of outliving your assets, or the family outliving the assets of the main earner or earners. And so my first question is really for both of you, so you can go and maybe we'll start with Bill and then Karen. To what extent do you think that Social Security is well functioning at providing that insurance value to the risk of outliving your assets? And what are the biggest areas of failure that you see?
Well, I think it's an excellent program in the sense of its insurance function. We know it is the most effective child poverty program. It's more effective than anything else we do, because that insurance against the loss of that parent is huge. And when we look at the reduction in child poverty because of death of a parent or a parent becoming disabled, it plays a larger role in lowering Black child poverty than any other program that we have. So does it provide this key floor? I think it does a great job. I think this is my problem with people only thinking about 1983 and ignoring how the program functioned before then. Before then, because we did have dialogue about the program, it was always being revamped. It was not a stasis program. It evolved to this point. So the expansion of disability, the lowering of the age of eligibility, the rapid way in which workers become eligible so their children can get the survivor's benefit, these were all adaptations since 1936, the expansion of workers who are covered by Social Security. So by the time we get to 1980, this is a program that had solved many of its racial disparities. But it was a program we were always discussing and seeing your question. What did we miss? What didn't we understand? Where's the gap in giving workers and their families that protection from the drop in someone working? We don't ask that anymore. And so I'm glad you asked the question, because we know we still have a couple of equity issues when it comes to women, and how do we really think about caregiving and the role of caregiving beyond if you're married. So what happens for women who may bear huge disruptions to their lifetime earnings because of caregiving? And that's one area we haven't built in. If we had paid family leave, and many people would argue it ought to be in this system, because what are the things that can happen to me as a worker that I need to be insured against so I can maintain my family? One of those that has a social benefit is, I hope you're taking care of your kid. So we should think of that disruption to someone's lifetime earnings because of childcare. We ought to be thinking about paid family leave. That is one crucial area that we've left out. And we know when we compare the United States to all other industrialized countries, we have the biggest gender pay gap. Our only competition is Turkey. Otherwise, we would be last. So that's not a good statement when you say that we're trying to outrun Turkey when it comes to gender inequality on pay. A big way that we could address that, and the reason everybody else has an advantage is they have paid maternity leave.
Thanks. Anything to add, Karen?
Well, I think since Social Security was largely a policy designed to alleviate poverty, or so old age people weren't destitute, in some sense the system has failed. The persistence of 10% in poverty for 20 years, even though real wages have been rising, really says that the system fails to meet the needs of those most needy. So who is it who ends up in poverty in old age? It's not the low lifetime, it's not the person who works with low wages for 40 years. It's the person who has very intermittent and short careers. They're disabled largely. The reason I'm not working is because I can't work. And those people, the benefit formula just fails them. It doesn't, it does provide a replacement rate on your earnings, but when those earnings only have 10 years of earnings or 12 years of earnings, it's low. And so I think the program really needs to improve the benefits for low-income workers. It really needs to actually provide a minimum benefit that provides a poverty level, at least a poverty level benefit. And so in that sense, it's failed.
All right. So I'm a health economist, so I'm gonna ask some questions related to health and life expectancy. And one of the very just striking charts is the difference in that you showed, Bill, the difference in life expectancy between the top quintile and the bottom quintile groups, more than 10 years of difference, which is huge. So there's another gap that is also huge in the US, and that's geography based. So there's, if you look across the United States, people say that your zip code where you live is one of the things that's most predictive of your health and your longevity. And there's just enormous differences in life expectancy by region. So it's 10 years gap between the top 1% of counties and the bottom 1% on life expectancy. So of a similar magnitude to that by income. And obviously income is correlated across regions as well. But to what extent, geography is not one of the things we've talked about a whole lot yet today, but there's just enormous differences in where you're born and where you grew up that features into your economic opportunity and your health. So is that missing in the conversation here? Is that relevant, or is that kind of already addressed by the way the program works? So maybe I'll start with you, Karen, and if Bill has things to add.
I mean, the program could have a more progressive benefit formula that basically says that the lower lifetime earners are going to get a higher replacement rate. And that's just part of the program design. It is an insurance program. You'd like to think that it's going to insure you against being in poverty and old age. And the current provisions of the replacement rate formula isn't really accommodating the fact that high-income people are living longer. And that's just, all that is a benefit increase, lifetime benefit increase for the most wealthy people in the United States.
Yeah.
Well, here I think Karen is right about we don't sufficiently target the bottom. We do have a supplement program which has been starved to death and is at the core of the way we debate even this program. And it's the debate of the day because people have in their heads that anyone who doesn't work should die. And they want to dress it up. I don't want them to die, but then they say, I want you to die. So that's the challenge because the very low beneficiaries, as Karen was pointing out, aren't the people, the formula doesn't fit. The formula fits if you are a constant worker. It doesn't fit if because of disability you don't get work that often. It doesn't fit if you live in a state that is punishing to workers. So it's your zip code, but it's also true that the disproportionate share of people who get disability live in the South. It is also true that those are those states that have no workers' compensation program, have very little unemployment insurance program, which is original part of the Social Security Act, and have no minimum wage. So these are states that have it in for working people, full stop, period. There's no dimension on which those states, K-12, education, I mean, it's not just how long you're gonna live, but will your state have spent some decent amount of money on your education? And as much as people wanna say, you know, LA is this horrible school district, you'd rather be in LA than in Mississippi. So the bigger disparity is between states when it comes to every opportunity. You would hope that we could design federal programs that could fly over and save these people living behind the cotton curtain. But therein lies the political problem, because they get huge representation in the Senate. So you have this competition between the cotton curtain and the rest of us who live in states, like if you live here, you do have paid family leave. So that's the challenge. The program itself, of course, was a compromise with the cotton curtain, which is why Black people were facing disproportionate lack of access to Social Security. It's part of the cause of the wealth gap, is that Social Security exclusion. And it took time for us to reach some political settlement with that part of the country to finally include Black workers, to finally get benefit levels and formulas that could address those workers who tended to be lower income. We need that same sense of solidarity. I always say, if you're poor, you don't live in the United States. If you're poor, you live in California or Mississippi. You're a Mississippian if you're poor. You're not an American. And so until we get to the point of, no, we have to have floors for Americans, whether they're South Carolinians or Californians, then this is the political fight we're having.
So let me ask one more question about life expectancy. So there's been a lot of focus on life expectancy in recent years as the United States, well, for decades, even as our life expectancy has increased, it's been increasing at a much slower rate than many of our peer countries, which is usually viewed as a negative thing, although in this room it seems like there's some talk about that being a positive thing from, I guess, for the budgets. But what I think where the alarm bells really went off was a few years ago when life expectancy in the U.S. it flatlined and then started to actually decline, and that was even before the pandemic. Strikingly, if you look at life expectancy in the trustees report for 2023, it reported from based on life tables from 2019 and 2020. So across that over just a 1-year period, life expectancy for men declined by 2 years, which is just huge. But one of the things, so I pulled up the numbers what I was curious about is how much uncertainty, what's the spread? I mean, not everybody lives to exactly life expectancy, right? Some people die much younger, some much older, and there's a wide spread. How much spread and what has changed in that spread? So from 2019 to 2020, if you look at the interdecile range, so what's the age that 10% of people live longer than that, and what's the younger age where 10% of people die before that? How big of a spread is that? That spread, even as life expectancy went down, the spread went up. It increased by 2 years. And so I think this gets to this question of the insurance value of the program and so a lot, we talk about differences in average life expectancy across groups, but even within groups, there's a lot of heterogeneity in that. And in fact, it may be correlated with the people who have groups that have lower life expectancy may have more uncertainty. So my question for you is just this, which is kind of thinking about not just life expectancy on average, but kind of how much spread there is in life expectancy and the insurance value that you get as a result from the program. Is that something that is on people's minds? Is that a focus, or should it be more of a focus when people are thinking about Social Security?
Well, I know some of the current debate right now in Social Security reform talks about addressing the disparities in life expectancy, which would be something like, okay, we want to increase the full retirement age, but let's not do it for people in the bottom earnings, lifetime earnings quintile. So understanding that low-income people are disadvantaged by an increase in the full retirement age. So those are options. You know, improving health insurance coverage in the United States would help reduce the early deaths of people, right? If you've got obesity, diabetes, you've got a lot of things that are happening sort of midlife that are reducing life expectancy, and improving health insurance coverage and access would help increase our life expectancy relative to our peer countries.
Yeah, so people misinterpret the life expectancy when they think about black people in particular, because they say, you know, you don't live to get the benefit, which is true, but they ignore that. Yes, but if you're black and you make it to 65, then your life expectancy looks very close to white life expectancy. There's only a little difference. It's really that the black distribution is shifted totally to the left, and therefore they ignore this insurance is really crucial because workers die. And so constantly when you know, I hear people trying to tinker with the formulas, they forget you've just tinkered with the disability benefit. You've just tinkered with the survivor's benefit, because there's one formula. So that has real repercussions for those folks who don't make it. It is disturbing because the dominant view in the way we characterize the issue is people are living longer. That has not been true for some time, as you point out. And so continuing that rhetoric really doesn't help in trying to find a solution either. And we need to think about it. It is workers per dependents. So when you look at it from the perspective of before, when we had this big baby boom, the number of people who worked compared to dependents, those who were too old or those who were young, workers supported a lot more people. The number of worker per dependent was a lot different. Now, it was individualized because we make your children. They are not our future. I hate to tell you. You know, as much as we always say, our children are our future. Our children are not our future. Our children are your problem. It's your child. So because we haven't socialized and realized that, yes, our children are our future, we don't think about it that way, but the reality is that the ratio of workers to how many people are workers supporting has been falling. It's not going up. It's just the part that we have agreed that we will socialize those who are older. If we socialize those who are younger, actually our problem would be getting smaller. And if we had always socialized the younger, then maybe, you know, this whole thing would look differently from the way we talk about it and what the issues are. Maybe if people will come to their senses about what is the real problem we're trying to solve from a national perspective, and what's the benefit of allowing people to retire versus allowing our children to have real, meaningful starts at life, you know, we'd be in a different position. But we're not there politically because kids don't work unless you live in Iowa. So,
or Central Illinois.
Or Central Illinois. So, I mean, this is the deeper crux of part of the issue. But you know, as much as our lack of insurance, Texas still has a high share of people not insured, and all the states that didn't take the Affordable Care Act up still have huge gaps in insurance. But Americans with insurance don't live as long as other people. So even those of us with insurance live in a sick society. And we know part of that is because we agree that you can shoot anybody in the United States you want to. They can drive into your driveway. They can knock on your door. We allow you to get shot. So, I mean, that's part of our problem. But we have a deeper problem, even for those who are insured compared to other countries. And so we have to think about, you know, this is a sick society. And we need to have a conversation about why is this a sick society?
All right, these are great comments. We have some time now for questions from the audience. So any questions? We have one over here. Yeah, Andrew.
Karen, I'm wondering if you could talk a little bit about the recent work looking or measuring seniors' incomes using household survey data like the CPS versus administrative data, say IRS data. And the Census Bureau has done quite a bit of work on that. And the reason I'm asking is not just, it does produce different levels, but the trend, the trend in poverty you showed was stagnating poverty, no longer declining. That's in the CPS. I believe that is not if you look in administrative data. Probably a lot of people don't know about it. I just find the whole thing very interesting. Maybe you could just talk a little bit about it.
I do know about this literature. So the Census Bureau for many years now have been looking at administrative data to understand basically where it's, so the poverty numbers come from the current population survey, ASEC data. And there are a couple of things that happen. First of all, with the shift from defined benefit pensions to defined contribution pensions, more and more of people's savings are coming in DC plans. But when you spend from your retirement account, census doesn't call that income, right? So you buy a refrigerator, people, let's say you've got a $300 increase in your income. So Census Bureau really does miss the spend down in retirement accounts. And so what does that mean? It means it's reducing the amount of income available to, and it's a cohort phenomenon, right? Because people in the early cohorts had DB pensions and people in later cohorts have DC pensions. So you're systematically understating the amount of resources available to later cohorts. So what does that mean? That means that if you go to the CPS and you ask about what's happening to income, it means the incomes are too low because it's missing that. The other thing that's happening is it also, the poverty rates are too high. So yes, there is a misstatement. And the poverty rate is about 3 percentage points, is that about right? And about 23% in income. So the income differences are bigger than the poverty rate differences, but they're very unequally distributed because where is the gap? It's largely coming from the misstatement of the defined contribution pension withdrawals that census misses. Okay, so the numbers that I showed you come from, so the Urban Institute has a dynamic microsimulation model called Dynasim. It's a dynamic model trying to look at the distribution of the population and Social Security reforms. I do account for those differences. So my model does understand that there is these DC pensions. Those DC pensions are giving you some means in retirement. So I do account for that. And my poverty rates are lower than what the Census Bureau shows, and my mean incomes are higher. But the trends, the trends that I'm showing which are like rising real incomes, that's true. Declining poverty rate, that's true. But the current Social Security benefit formula does not have a minimum benefit. And so there are people who have low lifetime earnings who end up in poverty. And that just has not been declining. But it is 3 percentage point lower than what the Census Bureau shows.
Thanks. Mark?
Super interesting. Just following up on that point about the Social Security benefit, because as you know, the benefit formula, you have to have earnings to get anything from Social Security, retirement or what have you, or for your children or your spouses or what have you to get it. But there is, maybe you can talk a little bit about the importance of the SSI program, Supplemental Security Income. So SSI provides maximum benefit for a person of $914. So if you were, let's say, born low income and you never earned, suppose you had a serious disability, let's say, throughout your prime age, your 20s, 30s, 40s, and so forth, often you'd be receiving SSI, which is about $914 a month, the maximum benefit. So it's not enough to lift out of poverty. But maybe you can comment on, because you were saying that Social Security should do it. Should it instead happen in a program like SSI? Your comment on that.
Well, they certainly could reform the SSI program to fill in the gap. But the asset limits in the SSI program have been stagnant for year after year, and they're trivial at this point. And so a lot of people who people who get SSI are poor. There's just no question about it. It's means tested, the benefit is low, and there's an asset test. So these are poor people. Absolutely, you could expand the benefit for SSI. And so I worked with the Bipartisan Policy Commission when they were doing their reform proposals, and they did look at, so that there was some question about, well, how should we fill in the gap at the bottom, and should it be done through SSI or should it be done through Social Security? And a lot of people on the commission felt like it should be done through the Social Security provisions, and they targeted the low-income population by increasing the minimum benefit. So a minimum benefit, you could even have a minimum guarantee that says, hey, if I'm over 65, I'm going to give them at least a poverty level benefit. So, and it doesn't cost that much, right? Because yes, there's a gap. The gap is not that big relative to benefits that are paid out in total. So with relatively minor changes in policy, we could eliminate old age poverty.
I'll just tell you, because one of my jobs that wasn't listed was for 6 years I headed the National Urban League's office in Washington. Among those of us in the advocacy community have long known that SSI could do better, but bringing it up would cause fear among all of us, because the politics is to cut the benefit. And every time you said, well, maybe we could get their sympathy for X, like maybe, we could help out people who get cancer. No, because then they're going to attack everybody else. I mean, the meanness in our system towards someone who isn't working is boundless. And so most of us, even when we had what we thought were wonderful ideas about what would make SSI better, would always corner that person and say, is this worth the fight, given what we think we're going to have to give up in order to get your great idea onto the table? It is, from my perspective, the bigger issue in the way we perceive this program. This is perceived as government expenditures. Any government expenditure is bad, and it's perceived as helping people who don't work. That's bad. So you're fighting a philosophical, a religious fight. You're fighting a religious fight, and that's what makes it so hard in trying to figure out where's the compromise when there's this religious kind of view about how some people think the system is supposed to work, and people who are afraid of what I call the true moral equation. I point out to people all the time, if you tell me you must work, I have 3 fingers pointing at me when I'm pointing at you. So if you must work, then I must have responsibilities that you can have a job, that it's a decent job, that you will not be poor if you work. You have a lot of social obligations to meet that equation. I rarely run into someone who wants to answer the 3 social obligations. Ensure that we always have full employment, ensure that every job is above the poverty wage, ensure that every job is not only above the poverty wage, but I get health insurance, ensure that it gives me retirement. Nobody wants to answer the 3 when they're pointing to 1. So that's why I say it's religious, is not moral, because if there was a moral equation and a moral debate, then people would answer the 3, what happens if I can't? And Social Security answers the can't. If you tell me I have to work, what happens if I can't? What happens if I become disabled? What happens if I'm dead? And that's what Social Security answers. It answers the other part of the moral equation. Society says you have an obligation, but society says we have an obligation too.
All right, we have time for one more quick question and quick response. Okay, right here.
Thank you. Thanks for this. To what degree are these middle-aged deaths of despair, which are accounted for largely by whites, influencing the life expectancy leveling and potentially decline? And is that in some ways reducing the race? Not the way you'd want to do it, but I just wonder how you factor that into the life expectancy.
I wonder if, David, you want to answer that as a health economist.
I'll start with the panelists.
It's the wrong way to solve the equation. Well, unfortunately, the we were getting convergence in part for the wrong reason, because white people were dying. But then sort of just before COVID and then now because of COVID, it's diverged again. So we're, as a nation, not going in the right direction.
But I would hope that COVID is a blip and not a long time persistent problem. So yes, something happened in the last 2 years because of COVID, but I don't think that's a permanent state. The deaths of despair is a bigger problem.
All right, well, with that, I just want to give a round of applause and thanks to our panelists.
For a break for lunch. There are 30 minutes until our keynote speaker begins, and there are lunches available. There are not lunches available. Oh, okay. Okay, so lunch will be here in about 10 minutes. Thank you. All right, everyone. I have the unpopular job of corralling everyone back so that we can get started with today's lunch keynote. People are filtering into the room. So it is a real honor to introduce Peter Orszag, who will be delivering the keynote address today at our policy forum. Peter is the CEO of financial advisory at Lazard, Freres and Company, LLC, and leads the firm's advisory businesses that serve companies and governments across the globe. He has served in a variety of influential economic policy roles, including as a senior economist at the Council of Economic Advisors, a special assistant to President Clinton for economic policy, the director of the Congressional Budget Office, and the director of President Obama's Office of Management and Budget. Peter has written extensively on healthcare spending growth and Social Security reform. Most notably, he's the author of a 2006 book with Peter Diamond titled Saving Social Security, A Balanced Approach. We're sorry that Peter could not join us today in person, but so pleased that he could still make the time to deliver the keynote speech virtually. And I will hand it over to Peter right now, and then I will ask him some questions in a few moments after his remarks. So thank you, Peter, and let's welcome him to deliver today's keynote.
Well, thank you very much. And again, I am deeply sorry that I could not be with you. I am a huge fan of CEPRS, and I appreciate the invitation and greetings to everyone. I thought that this would be a good opportunity, if we could start to put up the slides, a good opportunity to look back on Diamond Orszag and what's changed since then, and also to talk about the pathway forward, perhaps. You know, the reason that Peter Diamond and I wrote the book was that at the time, there was no reform plan that restored actuarial balance within Social Security in a what we would call traditional way. In other words, balancing some things on the cost side and some things on the income side. And instead, the whole rage at the time was some form of private accounts, or a little less to a lesser degree, investing the trust fund in equity. So some sort of equity premium play, either routed through private accounts or not. But traditional plans that eschewed playing off of that equity premium really didn't exist, and that's what we wanted to do. So I guess since then, just to kind of summarize things, private accounts as part of Social Security, I think, are pretty much dead, but so are traditional reform plans. So I don't know exactly where that leaves us, but what I wanted to do is just take a quick look back at what's changed since 2005, and then again, talk a little bit about the potential pathway forward and leave most of the time for questions. So a few things. First, since we wrote the book, the actuarial balance within Social Security has deteriorated, pretty materially. We show on the left here the 2004 projection as it stood when Peter and I were writing in the dotted line, and the darker line is what's actually transpired and then what's projected to transpire. And I think you can see that, at least from a trust fund projection perspective, things have turned out much worse than what was expected at the time. And on the right, we break down why that's occurred. And you can see it's a combination to date of both lower income, that's the black line on the bottom, and higher cost, which is the kind of grayish line on the top, compared to what the actuaries at least were expecting circa 2004, 2005. To break that down a little bit more, we thought it might be useful to break the actuarial imbalance into two pieces. One, and starting from the point at which the Greenspan reforms were enacted, at which point there was a 75-year actuarial neutrality or balance that existed. A series of changes that occurred basically up to when we did the book, and then series of other changes since then. And at the bottom, you can see that the actuarial imbalance around the time we were writing was about 1.9% of taxable payroll. It's now basically doubled to 3.6. And to break the changes down a little bit, what this chart does is just follow the Office of the Chief Actuary in categorizing the underlying drivers of that expanded actuarial imbalance. And the things that are particularly notable are the changes in economic assumptions, which really has to do with lower than expected productivity and wage and GDP growth and a variety of other factors, but that's quite significant. Obviously, the change in the terminal year also matters. This is a somewhat artificial 75-year window. And so as you move through time with an income and cost imbalance in the 75th year, the 75-year imbalance gets larger. So that's a second material change. And then there's a whole variety of other things. But I actually, having been away from this topic for a few years, was surprised to see, I'm sure everyone in the room who covers this or follows this more closely than I have been, at least for a few years, probably already knew this, but I frankly just was surprised by how much things had moved since Peter and I had co-authored that volume in a negative way. Just to dig into that a little bit more, what's also interesting is that while on the top bank here we show what's happened to some of the key economic indicators, and they've obviously bounced around a fair amount. When you look at the forward-looking projections, not much has changed, and I know the fonts may be small, but basically relative to 2004, the current estimates for productivity growth, real wage growth, to some degree GDP growth, are basically in line with where they were. CPI growth assumptions, despite the current bout of inflation, have come down a bit, as has the projected unemployment rate, and as has the real interest rate that's applied to the trust fund assets. But in general, it's kind of striking that, at least on the left side, with regard to kind of the real economic indicators, the estimates looking forward haven't moved that much. And I think this may just underscore the underlying tendency of the actuarial assumptions to move pretty slowly, even when things are bouncing around a lot in the meanwhile. So the other thing that Peter Diamond and I were sort of, I don't want to say at the cutting edge of, because there had been a bunch of there had been a bunch of studies already pointing it out, but I think we were somewhat early to the observation involving growing differentials in life expectancy and how that could affect our entitlement program. So this was part of the book. At the time, it was kind of novel. Since then, there's been a lot of confirming evidence. But just to break this down a little bit, on the left, you see life expectancy at birth, the big drop associated with COVID. Let me immediately say that doesn't mean, as everyone in the room I'm sure understands already, but sometimes in the media it can get confusing. It doesn't mean that our own life expectancies have declined that precipitously. This is not a cohort life expectancy calculation. It's a period life expectancy calculation. And again, the drop is really just associated with the excess mortality associated with COVID, which I'll come back to in a moment. On the right is, I think, a somewhat more interesting take, which is a demonstration of this growing gap in life expectancy, growing differential in life expectancy by lifetime income or by socioeconomic status. And again, there's been a whole variety of different research that has occurred over the past 15 to 20 years demonstrating this general effect. There have been a few papers suggesting it has not been occurring, but the overwhelming bulk of the evidence highlights this growing gap in life expectancy by either lifetime income or socioeconomic status. This is shown at age 50, but at pretty much any age, you see this increasing gap in life expectancy by SES. The part that's probably a little bit less appreciated is what that does to our major entitlement programs. So this is a set of charts from a National Academies study that I co-chaired with Ron Lee. And what it does is it takes the present value of entitlement program benefits for people born in different years in different lifetime income quintiles. And what you see is that if you look either for males or females at the 1930 birth cohort, overall entitlement programs, let's just focus on males for a second, were roughly neutral distributionally. So there's not much difference across the quintiles, at least in aggregate dollars. Obviously, as a percentage of income, the conclusion would change somewhat in terms of the degree of progressivity, but it's either neutral to progressive with regard to the overall entitlement program benefits. As you move to the 1960 birth cohort and that growing gap in life expectancy occurs, you see a much different picture in which the higher income individuals are receiving larger lifetime benefits in present value dollars than lower income Americans. And again, that mostly just reflects the fact that as life expectancy gaps widen, higher income people receive their benefits for a longer period of time relative to lower income people. And wherever you started from a distributional perspective, the overall system becomes less progressive as a result. The right side shows similar effects in terms of becoming less progressive, although the levels of progressivity are somewhat different for females. So this is something that Peter and I had highlighted a bit in our book, and we actually designed some features of Social Security to offset the impact of these changes. If anything, I think, again, the case for reflecting this differential in life expectancy across income and socioeconomic status has grown stronger since 2004, 2005. The other thing that was noteworthy in terms of what's happened since 2004-05 is we've been experiencing something that almost no one remarks upon except perhaps the people in this room, which is that the normal retirement age, which as everyone knows is neither normal nor a retirement age, has been increasing basically without any political debate and without many people noticing. So it's fascinating. This was a reform that was put in place as part of the Greenspan reforms, as I think everyone in the room probably knows. That it's been occurring and ongoing without much political debate. There are very few politicians standing up and saying we need to stop the increase in the retirement age that's occurring as we speak, or as the world turns currently. And I want to come back to that at the very end. Finally, before turning to a sort of more forward-looking perspective, I asked Steve Goss, who did me a favor, to just kind of update very briefly what the types of proposals in Diamond-Orzag would do to the actuarial imbalance today relative to what they did at the time. At the time, they eliminated the actuarial imbalance. Today, just given the larger underlying actuarial balance as a starting point, what Peter and I had proposed would no longer do the job. And part of that is just that the window has moved, but part of that is also a more complicated take on the various changes that I highlighted in terms of what's shifted since then. All right, well, what about looking forward? That's all hopefully at least moderately interesting, or maybe not, with regard to what's been happening over the past 15 or 20 years. What can we expect with regard to forward-looking Social Security projections and uncertainty? And I just wanted to highlight a couple quick points. The first is just the huge impact that life expectancy itself has on the actuarial balance and how hard it is to predict the changes in mortality rates going forward. So on the left, we just show a series of different somewhat plausible assumptions. Maybe flat is a little aggressive on the downside, but picking between the low cost and the which is basically in line with the pre-COVID trend, versus the high cost is, I think, a very, very difficult task. And the point here is just that the variation across somewhat reasonable different assumptions has a massive impact on the projected actuarial imbalance over the next 75 years, and especially in the 75th year, which is what we show on the right side there by 2, 3, 4 points or more as you vary across these somewhat plausible scenarios. I'll come back to this point later, maybe during the Q&A, but it's worth pausing and thinking about how we should reflect this underlying uncertainty in the forward-looking mortality rates in any Social Security design. The other thing that I think is worth just highlighting briefly is this debate about whether COVID will change the mortality rate projections going forward, because in a sense, the people that were most at risk and that unfortunately may have suffered from COVID-related mortality were the most frail parts of the society. And so going forward, you've got a different distribution of people and therefore maybe a different life expectancy trajectory. The only problem with that, and I know these numbers may be hard to read, is it does appear to be the case that mortality rates over the past couple of years were exceptionally high, not just because of COVID, but also because of non-COVID related causes. I will immediately admit that it's very hard to separate what's COVID related and what's not COVID related, although there are a variety of categories that seem more removed from COVID causes and that still saw fairly significant increases in mortality rates relative to the situation, say, in 2019 before COVID hit. So I think we need to be cautious about concluding that the mortality experience going forward will be fundamentally different because COVID happened and the distribution of people that survived is different than the distribution of people that were alive before COVID hit, underscoring to some degree the point about ambiguity in the mortality rate going forward. The impact of fertility rates is also, I think, well appreciated, but it is just stunning to look at what a big impact they have. Again, I don't think that anyone can confidently predict whether we're going to sort of flatline. I guess it's even possible we'll continue to experience declines in fertility rates. But the variation here on the assumptions on the left between some recovery in fertility rates versus going sideways, and then on the right, the impact, very large impact, on the 75th year actuarial imbalance, again, highlights how little we know about how the next 75 years will play out. One thing I would highlight on the fertility rate is not only the excellent work that Melissa Kearney and others have done about the decline in fertility rates within the United States, but a growing global concern, including, frankly, in areas of high fertility like in Africa, about how precipitous or rapid the declines have been over the past few years, and how that will affect the global situation, which is obviously only indirectly related to the topic du jour of Social Security projections. But I think the context of pretty rapidly declining fertility rates across the globe is stunning. So not too surprising, I think you're all familiar with just how wide the bands of uncertainty are around these projections going forward. We just wanted to highlight that with a 95% or so or 97% confidence interval varying between by 10, 15, 20 points of taxable payroll in the 75th year, which is a reflection of some of the factors that I was highlighting before. I want to make sure I get time for questions, so I'm going to just move quickly to two other quick topics. One is just, I know this is about Social Security, apologies, but it is really important to talk for a moment about our other major entitlement programs, especially Medicare. And here, frankly, the news is pretty good. This is I think, stunning chart that the Congressional Budget Office just put out about maybe a month ago in a letter to Senator Whitehouse, highlighting how their projections have changed from right before the Affordable Care Act was implemented to today. So that decrease in 2030 or 2033 of about 1.5 points of GDP is just massive, far larger than what traditional reforms of any type on the fiscal trajectory could hope to accomplish. And I think there is an important takeaway here, which is at the time, most people thought that the Affordable Care Act might, quote, solve coverage or do a lot on coverage, but do nothing on cost. There's a debate about what's caused this, this delta, but I strongly believe, and I'm very active in the field of healthcare and healthcare services, even today from a business perspective, that a lot of what happened here was the changes that were implemented as part of the Affordable Care Act. And the point there is that a lot of our budget discussions and entitlement reform discussions are very narrowly focused on moving this one parameter or that one parameter because that's what the actuaries or that's what the Congressional Budget Office can score and evaluate. Whereas a lot of times changing a whole variety of different structural features changes behavior in a way that produces bigger results than the narrow provisions that are easier to evaluate and easier to score. I'm going to skip the next slide, which I'm happy to talk about in Q&A, which has to do with health risk scores, and just go to maybe a few suggestions for how to move forward from here. The first, which I hope comes across from a lot of the prior points I was making, is a huge degree of humility that we should have about how the world will unfold. I think in a lot of these discussions, including in budget and Social Security reform discussions, there's this false precision of, it will be 1.8% or it will be 1.2 or it will be whatever. And I think we just need to realize that there is a ton of false precision that happens in those kinds of discussions. The second is that that's not sort of a nihilistic or there's nothing we can do in response to that. I would argue that what we want to do is try to make our programs and the overall fiscal stance respond more automatically to the underlying drivers of that uncertainty so that we put less emphasis on nailing it ex ante and allow the system to evolve ex post in a kind of organic way. A good example would be to talk for a moment about the life expectancy uncertainty that I mentioned before. And there is a philosophical question involved in Social Security. I think it is a reasonable position to take. It's the position that I embrace, that the annuitization feature of Social Security is not intended to protect, well, let me say what it is intended to protect first and then go to what it's not. It is intended to protect individuals within a cohort from outliving what was reasonable at the time of their retirement to expect in terms of their actual life experience. Or in other words, it is intended to protect an individual from outliving peers in their cohort. The way it's currently designed, though, it protects not only against that, but it also insulates entire cohorts and loads the implicit cost, at least, on somewhere else, either on the overall budget or on taxpayers with regard to changes in life expectancy at the cohort level over time. And it's that part where I think we can build in more automaticity so that basically the net present value of lifetime benefits is held roughly constant. And as life expectancy changes, if life expectancy goes up, the annual benefit goes down in response to that. And maybe that's something we can talk about. Next point is gradualism. So the slide I put up about the normal retirement age increase, I think is stunning by it's the dog that didn't bark, the lack of political debate that's happening as the normal retirement age goes up as we speak. And I think the reason is that it was done far in advance, and most importantly, and unlike the expiring tax provisions that get debated, when you have a very steep cliff, that drives attention and that drives political intervention and legislative intervention. Something that's done extremely gradually, people tend not to notice. And I think that's the biggest explanation for why this is, again, the dog that didn't bark. And then the final point before I open it up to the discussion part is that I think there are a whole variety of things that we can think about with regard to structural changes and not just programmatic ones. This comes back to my brief mention of Medicare and what's happened there in particular. so that discussions about long-term fiscal imbalance and even topics like Social Security should go beyond just the traditional parameters or the traditional interventions that everyone talks about and think more broadly. So the obvious example here is with regard to Social Security, other changes in society and other changes in other programs that could encourage longer work lives could have an effect on the overall program. Another obvious example is changes in immigration policy, but perhaps I'll just leave it there. And I am really looking forward to the Q&A. Again, I'm sorry I could not be there with you in person, but I'm delighted to be part of this conference nonetheless.
All right, thank you so much for those remarks, Peter. And it's a little lonely on the stage up here, but we'll make it work. So sometimes I think of Social Security as almost a defined benefit and a defined contribution system, in that the benefit structure is defined by law, the tax structure is also defined by law. And this is what gives rise to a lot of the uncertainties that you spoke about in your remarks. In terms of the cost and the income rate, and it's only by chance that sometimes those are going to equal out. Well, of course, someone has to bear the risk of changes in assumptions, so be it mortality improvements or changes in fertility. And so rather than framing reform as, what should be in the form of benefit cuts and what should be in the form of tax increases, you could also think about it as who should bear the risk that things don't play out as we expected. So it could be taxpayers, it could be beneficiaries, it could be future workers. And I'd be curious to hear about where you come out on that question, because I think your automaticity idea could work differently. Is it when you get to retirement, your benefits are adjusted, at that point, or are taxes the thing that's being adjusted?
Sure. So let me actually talk about the way Peter Diamond and I approach that question, because I do think it's a fantastic question. And what it really gets to is you can think of two different objectives here. One is, what are the provisions that, almost an expected value, eliminate the actuarial balance? And then what is the way to provide assurance that we don't get out of whack again in the future? And before I get to the sources of uncertainty, one of the obvious points that is just worth re-emphasizing here is to start with, even before you get to the sources of uncertainty, you have to eliminate not just the 75-year actuarial imbalance, but also the 75th year actuarial imbalance. Or else you're going to, as you move through time, which is exactly what happened following the Greenspan Commission, you're going to have a new hole open up. So that may be an obvious point, but it is worth emphasizing. Now, with regard to the underlying drivers of uncertainty, let me highlight two, and then talk about the ways that Peter and I at least thought about them. One is the evolution in life expectancy, including by income. So that growing gap in life expectancy, which if anyone can predict with certainty what that gap will be in 2070, that would be a remarkable feat. And the second is the evolution of income inequality, and in particular, what share of payroll is above the maximum taxable earnings level and therefore goes untaxed, which also affects the system's finances. So what we suggested with regard to the first point, and this comes back to, I guess, the philosophical point I was making about what underlying objective are you trying to accomplish with the implicit annuitization within Social Security, is to adjust at retirement. So you will know your annual benefit or your monthly benefit at retirement, and you're therefore protected going forward with regard to your own mortality experience. But basically at retirement, to adjust the benefit levels. We can go through the technical way in which we did that, but the monthly benefit level differentiated by average index monthly earnings in terms of effectively your lifetime earnings for the changes in mortality that have occurred year to year. So in other words, if life expectancy went up substantially over a 10-year period, the monthly benefits would be adjusted to offset the net present value impact of that, but to do so in a way that varied across average index monthly earnings to reflect the mortality changes that have occurred distributionally too, and not just the average. With regard to changes in income inequality, there are a whole variety of different ways of trying to index the system to that, but maybe the easiest thing to do is to just allow the maximum taxable earnings level to evolve in order to hit a certain share of total payroll that's taxable. So rather than setting the dollar level and then letting more dollars exceed the level as income inequality goes up, you could instead say our goal is that 90% or whatever, make up your number, X percent of taxable payroll will actually be taxed, and we're going to adjust the maximum taxable earnings level to hit that objective. These are obviously value judgments in terms of where the adjustments should occur, but I guess what I would highlight is I think it's better to have that debate and design a structure that actually adjusts endogenously in the future to whatever actually happens, rather than thinking that we can kind of fix the system and then be done. And that may get to the politics of the situation, which is there are very few windows in which we have the political consensus to do anything. So when you do it, you want to really fix it, not do it to kind of just meet the actual imbalance at that moment, because it's so rare. I mean, it may be once every 30 years that or 40 years that we have the chance to actually do a pension reform. Same thing, by the way, an aside, and then I'll stop on this, but same thing on fiscal support during downturns. Every single time it becomes inconvenient to try to boost the automatic stabilizers. Oh no, we can't do it now. We're in an emergency. Oh no, blah, blah, blah. Every single time we miss the opportunity to build more automaticity into that part of the budget by strengthening the automatic stabilizers, which is what you actually want to do. And so there's a parallel here in terms of, with higher polarization in the political system, when you have your moment, which is going to be very rare, use it as well as possible, which means, I think, again, more automaticity.
I'm glad you brought up the parallel between kind of automatic stabilizers in terms of in times of downturns, because it has a lot of parallels. And I think so many economists feel like that is just a no-brainer and would similarly agree with your proposals on Social Security. And yet it doesn't seem like that's the way that policy is moving. So can you speak a little bit to the politics of this idea, like how to get people around something like automaticity in this context, and how that may have changed since you first came up with these ideas with Peter Diamond?
Well, look, since over the past 30 or 40 years, it's pretty clear that the system has become more polarized. I was just remarking to someone that at my confirmation hearing to become OMB director, Paul Ryan introduced me, which would never happen today. And I also got a unanimous vote, which I'm pretty sure it wouldn't happen for me personally, but I don't think it would happen for anyone today. It probably wouldn't have happened for me personally even back then at that. But it's just a completely different environment. And so I think the takeaway from that is, let's turn back to automatic stabilizers for a second, because it might be more timely. When you have the opportunity, whatever your party is, it's going to be very rare to have the trifecta of the White House, the House, and the Senate in today's environment. And if you don't have that, it's going to be very hard to legislate. But in those periods of time when there's an alignment, White House, House, and Senate, with sufficient majorities to do anything, you want to really look to the long term and not just solve the immediate problem. So the reason automatic stabilizers are never included in a stimulus package is that you feel like you've got a fixed budget for what you're going to do, and you don't want to spend any of it on things that are not kind of just immediate. Like you don't want to buy the insurance. Maybe that's the way of putting it. Buying insurance is always, it doesn't seem like you need it at the time because you really, you got to fix the immediate problem. And time after time after time, that's a mistake. So the takeaway is I can't predict when the Overton moment window will reopen for any of this stuff. But when it does, take freaking advantage of it and actually do something that is doesn't just fix the immediate problem, but that is structurally able to adjust to future conditions, because it may very well happen that 5 years after, 10 years after, 2 years after, you wish you had done that, and if you don't, it's a mistake. So that I think that's one clear takeaway.
I'll just ask one more question, then I'll turn it over to the audience. But you talked a lot about the uncertainty in terms of the costs of the program. There's also, I think, program uncertainty for workers and near retirees today as they think about how to make claiming decisions, working decisions, not knowing how the program might change in the next 10 years. And what are the costs of that uncertainty? So, you hear anecdotally sometimes people thinking they should claim now because, the program might change, so I better get my benefits early. That's one type of cost that could impose. But are there others?
Yeah, I hear that too. I always want to sit down with those folks and just kind of say, there are many risks in life. The thought that there would be, for either current or near retirees, a material immediate benefit cut just strikes me as like so far down the list of risks that I wouldn't be basing decisions on that. I think the risk instead is actually, ironically, to the rest of the budget, if you will, or the rest of the fiscal stance, because in the political pecking order, that current and near retirees are so high up the list that the adjustment is disproportionately likely to come from something else and not that. So it may well be affecting individual behavior to some degree. I think to the extent it is, it's probably mostly irrational, and that the real risk here, the real risk from not locking some of these parameters down, is the ambiguity that it imposes for less politically protected parts of the federal budget.
Great. I'd love to take questions from the audience if there are some. So I'm sure there are. Yeah, right here.
Hi, Peter. Thank you for coming. This is Mark. I don't know what you can see on your screen.
I can't see you, but I can hear you.
Okay, great. Well, great to have you here, and thanks for making time to be with us today. So I guess one thing that I just wanted to ask about is your sense of the plausibility that when 2031, 32, 33 rolls around, really nothing has happened, and basically the political winds are such that doing anything along the lines of the 83 amendments, whether it's gradual or immediate or anything else, is just not possible. And the program then is financed out of general revenues, as much of Medicare is, as you know. And is there anything that the research community can or should be doing to try to energize people to not just take what you could say is an easy way out, but maybe that's not what your take is on that?
So look, I think we're going to see well before 2030 kind of early indicators of whether how the political system in a highly polarized environment responds to looming deadlines. There's one approaching in, depending on exactly how tax receipts turn out, June, July of this year, involving the debt limit. So those sorts of forcing events, as you know, have been what drove the political process in the past, and I think it's fair to say that without the looming threat, I mean, there's always this debate of what does the trust fund mean, and probably the only thing it means is that when the trust fund's nearing exhaustion, as illustrated by the Greenspan Commission, it is an impetus for action. But though that was all in a somewhat different era, and I think the fragility around the debt limit is a good example of these forcing events may play out in different ways in the future than they have in the past. So I think the only part of the scenario that is likely is that as we get closer to 2030 or 2031 or 2032, the trust fund exhaustion date will obviously be approaching to a much, in a much more near-term perspective, because I think the odds of reform in the meanwhile are exceedingly low. How that plays out, though, Mark, I really don't have a great feel for, because we are living in a different era. Most of the political deals that were done in the past, including the Greenspan Commission, involved the thick middle of the political spectrum in Congress, and that middle is very, very thin today. So, how you get supermajorities or even, bipartisanship in favor of any Social Security reform, even when the trust fund date is approaching, I don't know. And then that raises, the immediate question that you went to about whether we just fund it out of general revenue. I guess what I would say is I think the system is likely to come under enormous strain before then. The debt limit is one example. And so I can't answer the question without knowing kind of what happens in the meanwhile, to pick up the pieces that may happen as these sort of traditional norms get weaker and weaker. And then your final part is the research community. I think, frankly, there's not much more that can be done to underscore that there is an imbalance in Social Security and that the solution set is pretty well known. So I don't really think it's on the research community at this point to be doing much more than what it's already been doing. This is fundamentally a sort of political polarization question, and the difficulty of dealing with problems ahead of time, which was always the case, but it's exacerbated by the polarization point. And unfortunately, I don't think the research community has much influence over the trend in political polarization.
I think we might have only time for one more question from the audience. I have more here if you don't. So, I wondered, Peter, if you could tell us a little bit about how your experience scoring proposals as director of the CBO influenced your thinking about cost estimates for reform, particularly in this context.
So I would say most of my time at the Congressional Budget Office was not really focused on Social Security. There was a lot of work on healthcare reform and how the Congressional Budget Office would assess those, a variety of reform proposals. And I guess that brings me back for a second to the chart about how much the Medicare expenditures and federal health expenditures as a share of GDP have declined relative to the projections from 2010. A lot of that was very, very difficult, or a lot of different provisions were very difficult for the Congressional Budget Office to evaluate. And let me spend 1 minute on what I think has actually happened, because that's informative to your question. I think what's actually happened here is that no one single provision, and this is why it's hard to score, no one single provision changed the mentality of insurance companies and providers towards a bit more value orientation instead of just volume. But the combination of lots of different things and a lot of rhetoric shifted the mindset and convinced people that fee-for-service was going to die and on its way out, which then in turn created a whole set of new behaviors. That combined with the information technology backbone, so electronic medical records, which I want to make clear in and of themselves don't reduce costs, but facilitate a whole variety of new analytics that so they facilitate changes that may lead to different cost trajectories as opposed to doing it directly. And these are all structural changes. You can't point to one single thing and say that was 0.25% of GDP. So maybe that's the biggest takeaway I had, which is when I was at CBO, I probably believed a little too much in the 10-year budget window and the precision of, sorry, you didn't quite make it. It's, you're off by 0.12. And since then, while I know that there has to be a set of rules that we keep score by, I've just grown a bit more skeptical about that level of precision, and in particular focus more on things that may be outside the scope of the traditional reform provisions, but that could ultimately have much larger effects than whatever's in the menu of options that are being described.
With that, we will end our session, but we are moving directly into the next one. But let's thank Peter for being with us. Right, so we have some chairs arriving, and while they are arriving, I just want to take a moment to introduce John Chauvin. John Chauvin needs no introduction in this room, but in the interest of fairness, I'm going to give him one. So, John is the former Trione director of CEPR and was the Charles R. Schwab Professor of Economics before becoming emeritus in 2019. But anyone who knows John knows that retirement takes on a very different meaning for him, and will not be surprised to hear that as an emeritus professor, he's developed a new course on financial literacy with Michael Boskin. He's continued organizing annual conferences on working longer, and he has added to his collection of over 100 professional articles during this time. So I just want to highlight a few things that John has worked on that is very relevant for today's event. He is the author of a 1999 book with Syl Schieber entitled The Real Deal, The History and Future of Social Security. And that book outlines a comprehensive proposal to reform Social Security. And he also wrote an influential 2004 paper in the American Economic Review with Robert Posen and Syl Schieber that introduced progressive price indexing. Finally, he also wrote a book with former Secretary of State and Treasury, George P. Shultz, entitled Putting Our House in Order, A Guide to Social Security and Healthcare Reform. Among John's many achievements, I credit him with teaching me basically everything I know about the topic as my PhD advisor. So with that, I will bring John to the stage, and he will introduce the panelists for the next session. So thanks, John.
Well, I must say I'm very proud to have Gopi as my student, and she didn't mention that she was a co-author of the book that I did with George Shultz, and that was a kind of amazing experience. I've been thinking about Social Security and working on Social Security for more than 40 years, so I predate the Greenspan Commission, and so that was 40 years ago, and as Gopi mentioned, we had this book that Syl Schieber and I did. It was written about 25 years ago, and it has the unassuming subtitle of The History and Future of Social Security. By then, the kind of trust fund problem that we're talking about today had been known for a decade. So the fact that the system was not going to be in balance has been known for 35 years. And so it's really kind of beyond disappointing to me that we haven't addressed the problem, having known about it for 35 years. And as you may know, the Committee for a Responsible Federal Budget has a set of principles that they think apply to Social Security reform, and their number one principle is fix it sooner rather than later. I think they should modify their expression and say, fix it late rather than later, because it should have been fixed a long time ago. Now, I wasn't able to be here this morning, so I don't quite know what you said about the 1983 reforms, but I was just going to mention a couple of things that might be relevant. One is, those reforms, the Greenspan reforms, were done at the very last minute. Literally, the checks were going to be delayed within about 3 months of the enactment of the Greenspan Commission. In other words, they were right against the deadline. And that also could have been seen several years earlier, but it wasn't. Second thing I would say is that was a truly bipartisan effort. I listened to what Peter had to say about whether it's possible today. I was just going to remember a couple of things that happened. You know, Reagan gets elected, and David Stockman is his kind of special assistant, boy genius, or whatever he was supposed to be, and they came up with a Social Security reform proposal that involved some immediate cuts, particularly for early retirees, and they sent their bill to the Senate, and the vote on that bill was 1 in favor, 99 against. So even Senator Dole, who was the Speaker of the head of the Senate for the Republican side, voted against it. So Reagan kind of had his head handed to him, and so did David Stockman. Their proposal was completely dead on arrival. Reagan had the sensible idea that, well, this is really tough, and I'm going to try to get reelected in 1984, so it's time for a compromise, a political compromise. Let's work on this together. And so he went to Speaker Tip O'Neill and said, we need a bipartisan commission, and here's the deal. You appoint 7 members, and I'll appoint 7 members. And so that was kind of the deal. And then Reagan, and you know, I don't know, I'm not claiming that Reagan was a genius or anything, but he did have a good idea. The next day, he announced his 7 appointments, and it was 4 Democrats and 3 Republicans. And it put tremendous pressure on Tip O'Neill to be equally bipartisan in his picks, and I think that had a lot to do with the success of that venture, that it truly was bipartisan. So, by the way, they also agreed within the commission on the size of the problem. Before that, the Republicans were saying, you know, benefits need to be cut, it's going to be a disaster, and the Democrats were saying, oh, the benefits are going to be fine, but maybe we need a tax increase. But they kind of agreed on the size of the problem, which was the starting point for those negotiations. So I think, despite the fact that we're here today, the Greenspan Commission was a tremendous success. And I mean, Social Security was literally going to be in dire trouble within 3 months, and here we are 40 years later, and it's getting to be in dire trouble, but they lengthened the life considerably. Okay, I'm not on this panel, so I'm going to introduce the speakers. So we have 2 great speakers, both of whom are PhDs in economics, both of whom know their way around Washington. So actually, Deborah Whitman, if you'd come up, and Andrew Biggs, if you'd come up, I'll introduce you, and then I'm going to have each of them talk for about 8 minutes. Then I'll ask them a couple of questions, and then you'll ask them some questions. Now, I think Deb, as she's known, she's the Executive Vice President and Chief Public Policy Officer of AARP, the American Association for Retired People, which looks after the interest of people 50 and over. And I must say I've always thought that the entry age of 50 seemed a little young, but that's what the AARP does. Before her current job at AARP, She was a staff economist for the Senate Special Committee on Aging. And even before that, she worked for the Congressional Research Service on topics such as Social Security reform and aging and the like. In these roles, she's worked across the aisle with members of Congress and probably is a good observer of what is politically feasible. And I'm going to keep these introductions short, but I had to note that she is a ZAG. She's a graduate of Gonzaga. Those of you who follow basketball, I know Gopi immediately recognized what I was talking about. And then she has her PhD from Syracuse, where her advisor was Doug Holtz-Egan. Okay, Andrew Biggs. He's equally impressive for us in this role. He is a senior fellow of the American Enterprise Institute. Importantly, he is a senior policy fellow here at CEPR, should mention that. And he works on Social Security reform and also on state and local pension issues, of which there are a lot, as you may know. Andrew is a former principal deputy director of Social Security. So he's been there and done that. He also was the associate director of the President's National Economic Council under President George W. Bush. And like Deb, he knows his way around Washington, which is kind of relevant to this. And his PhD is from LSE. So I think what I'm going to do is ask Deb, if you want, you can go first. Whoever you guys want to go first. But they're each going to give talks. You can do it sitting there, or you can come up here, and then I'll ask a couple of questions, and then you guys can ask questions.
I'll start out.
Okay.
Well, thanks, John. Thanks, everybody. I should make a correction to one thing you said, John. You said I've been there and done that. The reality is I've been there and not done that, which is how we all end up here. But thank you all. Since we're in California, I'm going to open with some words from the state's greatest philosophers. That would be the Eagles. I am not going to say you can check out anytime you want, you can never leave. That would be lame even by my low standards. But in their song Already Gone, which I think is an underappreciated rocker, the Eagles tell us, quote, often, I need to get my gravitas here, oftentimes it happens that we live our lives in chains and we never even know we hold the key. And in 1974, California, that was considered to be very deep. But it has something to say to us today. 40 years after we last successfully reformed Social Security, 38 years after Social Security once again slipped into deficits, 30 years since the Social Security trustees declared that, quote, action should be taken to strengthen financing of the OASDI system. In other words, we've known for more than a generation the challenges we face in fixing the federal government's largest program, the largest tax that most workers pay, and the greatest source of income for most retirees. And since then, drum roll please, nothing. Despite efforts from President Clinton and Bush, precisely nothing has been done to address Social Security's growing funding shortfall. The question is why nothing? And how do we get to a future, and hopefully a near future, that contains something other than nothing? Why is Social Security so hard to fix when so many other countries that face the same demographic challenges we do have managed to reform their pension systems? My answer is our discussions of Social Security and Social Security reform have been unduly constrained. We work inside a box that restrains Social Security in ways that have very little to do with what in the abstract we want a government retirement program to accomplish. As a result, we're left with an increasingly expensive program that pays high benefits to retirees who really don't need them while providing inadequate protections to poor retirees who do. And I don't see things as much better today. In one sense, Republicans and Democrats have never been more united on Social Security. The two leading presidential candidates, current President Biden and former President Trump, have both pledged not to cut a penny from Social Security benefits. But neither Biden nor Trump have specified the tax increases needed to keep their promises. More worryingly, President Biden has constrained his choice set. No benefit cuts and no payroll tax increases on people earning less than $400,000, that it's literally almost impossible to imagine a reform plan that is consistent with them. Keeping Social Security solvent only by raising payroll taxes and earnings over $400,000 requires a tax rate of over 23% on those earnings. So good luck with that. Trump, for his part, I'm not even going to go there. I've only got a little time. But a package made up of the conventional provisions we talk about that would achieve 75-year solvency would have to increase the retirement age, cut benefits for the top half of retirees, reduce cost of living adjustments, raise the payroll tax ceiling to $300,000, and increase the payroll tax rate by a point or so. Any one of those today is a deal killer. So since the failure of the George W. Bush reforms in 2005, I've started to think differently about Social Security reform, or think differently about how I think about Social Security reform. Bush's reforms, and nearly all conventional reforms, start with the current tax and benefit formulas and tweak them in various technical ways to eventually bring costs and revenues back into balance. The goal is to maintain the program as a program, not to achieve the program's goals. I've thought about it from the other direction. Start with what we want Social Security to accomplish, then build a plan to get there. Imagine a person age 21 who hasn't yet entered the workforce. They haven't paid a penny into Social Security, nor are they owed a penny by the program. That person will not retire for another 45 years. We can give them any kind of Social Security program we want. More specifically, we can design a program that reflects our current judgments on what a social insurance program in the 21st century should look like, not early 20th century judgments on a retirement system for the early 20th century. The wonky stuff is designing the transition rules to get from here to there, which actually isn't very hard. That doesn't eliminate the problem of dealing with currently accrued benefits that we lack the resources to pay for, but it gives an easily understandable and defensible endpoint to reform. So if we were inventing a Social Security program for the 21st century from scratch for that 21-year-old, what would it look like? If we're being honest, my guess is precisely like the current program wouldn't be the answer. Here's what I would do. The general case for a government retirement program will be first, protect against destitution in old age, however you want to define destitution. A variety of risks, whether they be low lifetime earnings, health shocks, death of a spouse, or divorce, can lead to destitution in old age. We're a rich country, and protecting against poverty is actually cheap. If Social Security simply paid every retiree a poverty level benefit, thereby taking elderly poverty to zero, costs will be cut roughly in half. If you paid a means-tested benefit, where you're effectively just filling the poverty gap, the program would be even cheaper. That's what countries like Australia and New Zealand already do. Second, a public retirement system can protect against moral hazard and myopia by requiring everyone to save for retirement. Currently, we do that through Social Security. For instance, my wife and I will together collect about $80,000 a year in Social Security benefits when we retire. That's about 4 times the elderly poverty threshold, far above what any safety net program would provide. While protecting against poverty is cheap, providing 4 times the poverty line to millions of upper income households isn't. The maximum Social Security benefit today this year tops $43,000 for one retiree. That's 2 to 3 times higher than the maximum benefits paid in the United Kingdom, Australia, Canada, or New Zealand. But you know, there's another way to require people to save for retirement, which is, well, require people to save for retirement. In other words, let Social Security cover the poverty protection angle while mandated savings cover the income replacement angle on top of that. Some states are soft coercing savings via so-called auto IRA plans. So are the United Kingdom and New Zealand. Australia outright requires both a provision of a workplace retirement plan and participation in that plan. That wasn't possible when Social Security started for a whole variety of reasons, but it is possible today, so let's just do it. When I've spoken to Republican members of Congress, they often respond that we don't like mandates. We don't want to mandate people to offer a retirement plan or automatically enroll in them, but they forget that payroll taxes aren't voluntary either. And if we don't do something to address retirement savings on the household side, it is a near certainty that we're going to end up raising payroll taxes on the Social Security side. So they need to choose one or the other. The combination of a government-funded safety net and universal workplace retirement savings isn't my own creation, but that's how we know it can work. Australia has had such a system for a generation, and as social insurance, it has worked. The median retiree in the US has a disposable income that's 65% higher than Australia. And in fact, the median US retiree has the highest disposable income in the world. But at the 10th percentile of distribution, US seniors have incomes 15% below Australians. Why not rejigger Social Security benefits to address that? And this is happening while Australia spends about 1/3 less on cash benefits for seniors than does the US. And Australia's expenditures will remain steady or even decline as Social Security costs go up. And yet the current Social Security benefit structure, with no minimum benefit but a high maximum benefit, is often treated as if it's sacred. The story is that Americans won't support a targeted benefit program. As they say, a program for the poor is a poor program. I think the subsequent growth of a wide variety of federal means-tested programs kind of disproves that dictum, but maybe we can put a finer point on the history of the Social Security benefit formula and why it differs from other Anglo countries. Back when Social Security was being considered, the two main committee chairs were Southerners who had fathers who fought in the Civil War, and not for the winning side, if you get my drift. At the time, the Jackson, Mississippi Daily News succinctly put it, quote, "The average Mississippian can't imagine himself chipping in to pay pensions for able-bodied Negroes to sit around in idleness on front galleries, supporting all their kinfolk on pensions, while cotton and corn crops are crying for workers to get them out of the grass." This helps explain why we have the Social Security benefit formula that we have. We don't have a universal flat benefit that even at the time existed in countries like the United Kingdom. I'm not sure why we should treat that approach as if it's sacred when we have reason to believe it's anything but. Now, my idea of a flat dollar benefit to all retirees coupled with universal retirement savings plans is enough to bring Social Security back to solvency in the long run, even at current payroll tax rates. It doesn't directly address the short-run solvency problem, but indirectly it does. Social Security's trustees project Social Security's unfunded obligation is equal to 1.2% of GDP over the next 75 years. Guess what's worth 1.3% of GDP according to the CBO? The federal tax preference for retirement savings, 58% of which flows to the richest quintile of households, but probably doesn't do very much to actually increase retirement savings. And guess what you don't really need once you've offered every American a workplace retirement plan and either auto-enrolled or mandatorily enrolled them in it. Really, people, this isn't that hard if you're willing to think out the box. And not very far outside the box either. It's just trying to think comprehensively about what we want Social Security to do in the context of our larger retirement system. To close, Grace Hopper, who was both a computer scientist and a Navy Rear Admiral, said, "The most dangerous phrase in the English language is, quote, 'we've always done it this way.' Let's not let that be Social Security's epitaph." Thanks.
So I do have to fix one thing in my introduction. AARP is no longer the American Association for Retired People. We haven't been for almost 18 to 20 years. We dropped what it stood for because people over age 50 are not retired. So just wanted to point that out. One of the things I love about my job at AARP is I get to work on all of the different issues that affect people as they age. And I've worked on healthcare reform, on long-term care. And if you think about healthcare, I had doctors and nurses and insurance companies and pharmaceutical companies and hospitals and insurers all coming at me with their own particular sub-issue that affected them. We don't necessarily have that in Social Security. And so solving Social Security is in some ways deceptively easy. And I just want to talk a little bit of why it's maybe not as easy as we think, even though you've been hearing all kinds of a range of solutions. So first, I thought about doing some slides, and I'll tell you what the slide is, because I didn't get around to actually making them. So the first slide would be the equation for Social Security. And it's basically that tax revenues coming in, which is a percentage of the taxable payroll, have to be greater than or equal to the benefits being paid, which is the sum of a progressive earnings formula. You've heard PAAs thrown around by all of us, with reductions of claim by age, plus whatever's left in the trust fund, right? So we have a greater than equal than, simple math. But it's actually not that simple. You can't just cut benefits and raise taxes and everything is easy. And the reason that is because that both the system itself is a little bit more complicated than that easy equation that I could have wrote on a slide, and then people are more complicated. And so that's how I'm going to have most of my talk, is talking a little bit about the complexity of the system and a little bit about the complexity of real people. So first of all, and you heard Bill talk about this, there's many different types of beneficiaries within the program. And sometimes when we are mostly just talking about the retirement system, we don't really think about how one change on the retirement side over the typical worker can affect other populations. And so Bill reminded us this is an insurance program, that the benefit formula actually affects people who are disabled, children and other survivors. All of those things come into play. And I'll just give a specific example. For many years, there were ideas about how to help women in Social Security, because if you look at differences by gender, they're actually pretty significant. And so there was proposals by women's groups to have income sharing, or proposals to change from having a wife or spousal benefit to having a higher widow's benefit. And it wasn't actually until I'm looking at Karen and Melissa and Rich using the Dynasim model where we were actually able to say, wait a minute, if we did that, there's going to be all these divorced women that are going to be moved into poverty, because we are thinking about the spouse as living in a house with a man who has a higher benefit, but we're not taking into consideration. So these intersections within the program are really important when you're designing changes to it. The other thing is people forget that there are many, many programs, and I think Mark asked a good question about SSI. And so a lot of the programmatic changes, which are good intention to help low-income beneficiaries, such as raising the special minimum or others, forget that that few extra dollars that they might get through their Social Security check may push them out of accessing benefits for things like food stamps or, importantly, SSI. And SSI is more than just money. It's Medicaid eligibility as well. And once you get Medicaid, not only is your out-of-pocket cost for healthcare done, but you have a whole range of additional services for long-term services and supports that Medicare doesn't provide. So again, when we're thinking about this program, good intention changes, we're going to help low-income people, can have disastrous consequences if we don't look at the program in its entirety, as well as all of the other things it fixes. I will agree with Karen that SSI needs updating, and we need to do a lot there too, so just as a side note. Other proposals assume that there is a range of data that Social Security doesn't have. And Jay may correct me, because I haven't been at SSA for 25 years. But we don't have data on marriages. There's no national marriage registry. We don't have data necessarily in the SSA system about children. And so, well-intentioned ideas for child care credits really are hard to implement. ARP really cares a lot about family caregivers and the people that are taking care of older adults, where we know that there's huge burdens of care by the 38 million people that are trying to help out a loved one who also may have to drop out from work. So we would love to see, if we have childcare, also caregiver credits. But again, we don't have a national registry of who's providing care. Hopefully, we will have more benefits like paid family leave, or ARP is pushing for a income tax credit, but again, that captures dollars given, not time out of the labor force. So again, structuring changes, no matter how they're well intended, really needs to take a broad view. The other point is that Social Security itself has been changed by external events. You've heard a lot today about both the changes in birth rates. You saw Peter's slides up there. You've heard about changes in life expectancy and earnings inequality. Those have had really major changes to the program and implications for the distribution of the program overall. I think we haven't come to grips fully in our conversations about what disparities in life expectancy are and what the implications. Right now, again, post-pandemic, life expectancy has fallen, but Native American life expectancy is age 65 in 2021. They're not even making it to the new retirement ages. So when we talk about changing retirement age and we don't look at the effect on particular populations, as Bill talked about, we're missing a huge point. Socioeconomic status, we've heard as well. So the top 1% of men live 15 years longer than the bottom 1% of men. Women, it's about a decade. So that's 15 more years of benefits, or a decade for women. And that has radically changed the progressivity of Social Security. You heard Peter, and I actually have forgotten that he wrote the National Academy of Science report several years ago, but it found that the top 20% of beneficiaries, or the top 20% of earners, get more than $100,000 in benefits more than the bottom 20% of beneficiaries, just because of the differences in life expectancy. Again, 10 more years of benefits, you're gonna get a lot more totally. Rising inequities in earnings have also been a key driver of the long-term problems in Social Security. You heard that from Louise today. I just whispered with Kathleen, and if they had put automatic stabilizers to cover 80% or 90% of covered earnings back in the 1983 amendments, it would have made the program solvent to 2075. So this change in how people are getting paid and the lack of equity around earnings growth has made a huge impact on Social Security. Now, the final and probably most important point from my perspective is we're talking about the program as if it doesn't involve people. And as if people don't have things more going on to them than their Social Security check. And so I just want to talk a little bit about how it affects real people's lives, and real people take this very seriously. A recent poll from the AP NORC showed that almost 80% of respondents oppose reducing the size of Social Security benefits because they value them so much. And a poll that we did last December showed that 82% of people in their 50 to 64 and 84% of people age 65 and over think that the issue of Social Security, the issue of whether Social Security will be there for current and future retirees, is one of the biggest problems facing our country. So real people are concerned about this. They know how important those checks are to them. And so we know that even without any changes right now, the system itself has become has been changing with the automatic increases of the retirement age from 65 to 67. That's been a decline in benefits by roughly 12%. And you saw that Jay showed that's changed behavior. So people are claiming a year later. It means they're missing out on 1 year's worth of checks. So this is a real cost to people. The other thing we have to think about is people, when they get their checks, has the Medicare premium taken out of it for most people. And so what they see is the net amount of their Social Security, net without these healthcare costs. But premiums are only one part of what people pay. They also pay co-payments, other types of payments. And my team just put out a report showing that on average, the annual cost that somebody pays for premiums and medical services is over $6,000 a year. So remember, Social Security benefits on average are only $20,000 a year. So it's a growing share of your Social Security check that is just going towards your health care costs. We had Kaiser Family Foundation actually look at this and project it in the future. And by 2030, again, for oldest beneficiaries who have long-term care costs as well, 87 cents of every dollar of their Social Security check will be eaten up by health care costs and long-term care costs by the time you're 80. It's really hard to live on 13 cents of Social Security. And we see housing costs increase, and these are the things that I hear about when I talk to real people. The other thing is that Social Security is just one factor in people's lives. And the other slide I was going to put up is the 80,000 people in France protesting the increase in the retirement age there from 62 to 64, which sounds, very reasonable compared to what we're talking about. And I think that's not just because they're French and they like to protest. I think it's also because the government did this in isolation, right? So they're saying you have to work longer, but they didn't do anything for the demand for older workers, right? We know that people face all kinds of problems that they can't work after a certain point due to health issues or because their jobs are physically demanding. We're working with the National Academy of Social Insurance even to look at the US system to say how can we not harm disability but really address those people. Age discrimination is real and it's huge and it's increasing during the pandemic. We surveyed people in 2020, found that 78% of older workers either saw or experienced age discrimination at work. And while the US has somewhat strong age discrimination laws, they need to be stronger, it's still a huge problem. In fact, Karen's colleague, Rich Johnson at the Urban Institute, showed that half of all people in their 50s lose their job involuntarily at some point. So I don't know how many, I'm just looking around the room, quite a few of us are over age 50. Half of us will lose our jobs, maybe not in this room, in our 50s. And only 10% of us will actually get a job that pays the same when we go back to work. So we're not making sure that there's a demand for older workers. We're also not making sure that people have training and skills that they need. UK, I know my time is going up. So UK had a really interesting recent returnship and apprentice program that they're trying to think about these issues. At AARP, we're working with OECD and the World Economic Forums on a project called Living, Learning, and Earning Longer to try and get employers to think about the multi-generational workforce and think about how we can extend on the demand side the careers of people who want or need to work longer. Lastly, and Andrew touched on this, I don't think Social Security is the only thing that we need to fix to make sure that people have a secure retirement. We still have, 40% of people relying more than half of their income on Social Security. A piece of that is half of our labor force doesn't have a way to save through their paycheck. And half probably don't get the tax incentives that we have to save, as Andrew talked about, are very skewed. So we've been working state by state by state in order to pass what we call work and save laws. California has one of the first that's really functioning well. There are 8 other state plans that are operating. 7 states have legislation, and another 30 states are looking at it. So this idea that we need to offer workers whose employers don't have a retirement plan a way to do it through pooled resources is really taking storm, and mostly because workers want it, and even in red states, business owners want somebody else to take on that responsibility. But even if we do the best we can on retirement savings, Social Security, in my mind, still is better. It provides longevity insurance, inflation, disability, survivor, and a whole range of protections that retirement savings itself will never do. So in closing, I don't have a good song lyric. I tried to think of what I could say while I was there, but let me just say it's not just a simple math equation, even though I'm here at the Stanford Economics program. We really need to look at how any idea, good, bad, otherwise, is going to change the entire program and interact with other programs that people get. And more importantly, we need to think of it from the individual's standpoint and all of the different things that they're facing in retirement. There are so many things that need to fix. I have full employment probably for quite a few more years. But I guess I am firmly, and I think you've heard unanimously, we need to fix Social Security now, because the longer we wait, both the harder it is and the more uncertainty people have in their future. So I'm with John. I like it fix it late rather than later is my proposal for fixing Social Security. So thank you.
So I'm going to ask a few questions. My suggestion is you answer them briefly because you can get even better questions from the audience. So I'll try to turn it over to the audience so you guys can ask the good questions. In our first one is for Deb. In our pre-meeting, you mentioned that AARP had a set of principles for Social Security reform, and I don't know that you have to go through all of them, but could you maybe highlight one or two of the top ones? There also is the Committee for a Responsible Federal Budget. They have a set of principles, and you said, well, ours are a little different. So just elaborate a little bit.
Yeah, certainly. I'm not going to read all 8 principles. That would bore you to tears. They are on our website. I'll just say the difference is the Committee for Responsible Federal Budget is focused on the federal budget. ARP is focused on individuals. Our highest order of principles is that we want to make the program solvent and adequate for future generations. And so if I looked even at the paper of principles that Andrew and Gopi put out for today's event, most of them we agree with. But solvency shouldn't just be the goal. We also need adequacy. People need to have a benefit that they can actually live on. So we have a range of other particular proposals that maintain Social Security's current character, protects the people that are most in need, rewards work, and ensures fairness. So.
In our pre-meeting also, this is to both of you, traditionally people think, wow, there's 2 ways to fix this program. One is to cut the benefits and the other is to raise taxes. Now, Andrew, you have a new way of thinking about it, which was very interesting. But what I heard from both of you is that if we had fixed this on a timely basis, 30 years ago, 25 years ago, we might have had a combination of benefit cuts and tax increases. But as we've delayed, the chances of benefit cuts has been lowered, and the chances of tax increases has been increased. And I just thought maybe you could elaborate briefly on that, or if I didn't get it right, tell me. Andrew, why don't you start off?
I think you have it right. The basic math is, people do care about their own self-interest, and if you're a baby boomer paying your taxes into the program, you might care about your taxes. If you're now 20 years later a baby boomer collecting benefits on it, you collect more, you care more about your benefits. So I think that was inevitable. That as the population aged, political voting preferences would reflect that. You have less time to make these benefit changes. If we had done something 20 years ago, you could have transitioned changes in to make the system solvent. Now it's very difficult to do that on the benefit side. But I think you just see that reflected in the politics as well. Seniors are a Republican-heavy group now, so Republicans in particular have this conflict. They don't want to raise taxes. They also don't want to offend their voting group, and they're trying to figure out how to do it. But I think on that end, clearly they shifted more towards a revenue solution than a benefit cut solution.
And I'll just say, if you look at those charts of what happened in '83, there was a very small initial deficit. With the end of the trust fund, there'll be a very large one. And in 2035, you can't cut benefits for people who are, it is very hard. And again, you'd see lots of protests if you cut benefits for people that were in current retirement. So what are you going to do in 2035, 2036, 2037 if you can't cut benefits? You have to either raise taxes or use general revenue transfers for those early years. Long-term solutions, I think, open up more possibilities, but short-term solutions of how are you going to pay those checks in the first couple decades, or at least the first generation, make it really hard to do on the benefit side.
My next question is actually a variant of one Mark asked. What if we don't cut benefits and we don't raise taxes, and somehow we just get the government, the general federal government, to pick up the shortfall for Social Security? We just borrow the money. Two questions. Is that a likely outcome, and is that a desirable outcome?
You want to go first, Deb?
I don't think it's a likely long-term. I hope reasonable people can sit together and make reasonable compromises. That's what we're calling for, and that it needs to be done as soon as possible. How much general revenue, I think, will depend on how soon the changes are made. But I don't think that will be the only solution to Social Security.
I guess what I'd say is, if you remember Louise's presentation from this morning, she pointed out that the continued payment of full scheduled benefits is built into the CBO baseline for budgets and debt for the whole federal government. So in a sense, any change we would make to make Social Security solvent, raising taxes or cutting benefits, will reduce unified budget deficits. So you could say, well, just stick with the baseline and general revenue finance it or whatever we want to do. The problem is what CBO presents is an unsustainable baseline, that it's not something, where debt is ever increasing. Moreover, if you essentially exempt Social Security from fixing any of that structural deficit, it means all of it has to get resolved either essentially on Medicare or on the on-budget side, which I think is going to be very, very difficult to do. So, in theory, you can do it in the short term and maybe as a transition, but the worrying part is as poor as we're being at fixing Social Security, we've got a whole range of other problems to fix. And I'm worrying about how all this stuff comes together.
Okay, my final question is, say you're thinking about or know somebody who's 55 years old, they're working, they plan on retiring in 12 years at 67, the so-called normal retirement age, but they also hear that the trust fund's going to be exhausted exactly on the day they retire. What should they be thinking about? How much should they be counting on? How would you evaluate their problem of whether they're going to get what the current law says, or they're going to get less, or it just seems like they're dealing in a world of uncertainty?
Well, I think you're referring pretty specifically to me. Like, really specifically to me. I honestly don't worry about it at all. I mean, I'm a person who advocates for benefit cuts, and still I don't worry about benefit cuts. It's the closer you get to it, the less likely it is you're going to have your benefits cut. I worked in the Bush White House, and at the time he said nobody age 55 and over will be affected, and the policies have shifted to the left since then. So it's just not. It is a big. Social Security insolvency is a big problem, but it's much more a problem for the federal budget and for all the other things you want government to do than it is a problem for the retirees themselves. I actually feel personally very safe in my benefits.
All right, so I won't be a Debbie Downer, but I'm 53, so you're talking about me too. And I think it is a problem that we haven't made any changes since I was in junior high. The conversation about Social Security going bankrupt undermines people's belief. They don't understand that bankrupt, and I hate that word. We did a thing with the National Press Foundation trying to get the researchers to all repeat, it is not going bankrupt, there is a shortfall. So just the conversation around it is a problem, and you wrote a great paper recently that talked about the price of this uncertainty in people making their plans, because people will either save too much or save too little. And it's not just me that I'm worried about. Actually, I agree with Andrew. I'm less worried about me. I've got kids in their 20s. I want them to be able to plan and understand what they have to do in order to get their financial life in order. So I think your paper said it was about 2 months of salary, the cost of uncertainty, but maybe you can share with the group exactly what the numbers were.
I'm not sure I'm prepared to tell you exactly what the numbers are, but I do think there's an additional cost of the uncertainty, and that people that are trying to plan their lives, maybe even in a life cycle type model, it's unnecessary uncertainty. That is, if Congress decided what they're going to do in 2035 and announced it now, people would be better off than waiting for 12 years to figure out what they're going to do.
John, could I just touch on that quickly, though?
Yeah.
I think there's an important point that if Congress was going, if Congress knew how it was going to resolve Social Security, they had a secret agreement, and it was all signed in some back room, clearly you would like to know sooner rather than later.
Right.
What we have had, though, is, let's say beginning 1984, we knew then the system was going back into deficits. Imagine if we had just gradually increased the payroll tax as needed in order to keep the system solvent for the long term. Somebody, medium wage worker retiring 2034 would have paid an extra $100,000 or so in payroll taxes. Somebody at the tax max would have paid over $300,000 in additional payroll taxes. Had we done that back then, those people are not going to get their benefits cut. They massively benefited financially by deferring reform. So there's the uncertainty part you're getting at, and yet the delay in reforming Social Security has unequivocally benefited people who weren't forced to share in that cost, whether it's tax increases or benefit cuts, and that's shifted the cost more to people in the future. It's a fixed cost to the funding shortfall, 23 trillion or whatever it is. The more people we exempt by delaying it, the worse it is for people in the future, and that's their cost. I see it.
The baby boom generation is going to escape without paying much of the cost. Once you're my student, you're always going to be my helper. So Gopi's going to call on people. You may or may not know, but I have really terrible eyesight, so I probably couldn't see you waving your hand. And she also now can take responsibility for telling us when the session has to end.
Yes. We have about 10 more minutes for questions, so let's start right here.
So I've been listening to this discussion, and I am really confused, because if you ask me what the goals of Social Security are, I could not tell you. And I don't know how we can make policy recommendations if we can't clearly articulate what the goals are.
You're fully qualified to be a member of Congress, because they can't really explain it either. I mean, you could look in a textbook, but I think things like preventing destitution in old age, it might be poverty or however you want to define it, that's one. Providing assistance to people who are too poor to save on their own or who have some bad experience that would harm them. The second is forcing people to save for retirement over and above that amount. You have people who would lack the foresight to do that, and they might fall back relying on the taxpayer, and so you're insuring other people against that risk. And third, you have the annuitization, preventing people from outliving their assets. So I look at that and I say, okay, how do we want to solve that? And that's a slightly distinct question from how do we make Social Security, the program, solvent. And so I was just trying to get at these larger goals and saying there's more than one way to skin the cat.
And I'll just add, I mean, the title of the program is Old Age Survivors Disability Insurance. So we are purchasing an insurance policy that will protect us whether we become disabled in our from work, whether or not our loved ones pass away. So it's more than just a retirement savings program. It provides all kinds of things. And the insurance is also protection against longevity risks so that some people, may live much more years than they had been able to save for, and also inflation risk, which is huge at the moment.
Why don't we go back here with a question?
Thank you. Since this panel is about political economy, I wanted to ask more about the political landscape right now for Social Security. Earlier it was said that we had a thick middle during the Reagan administration that now has evaporated, but then Andrew mentioned that there's a surprising amount of overlap between the populist right and progressive left on Social Security. So it's obvious that polarization is a problem, but when it comes to Social Security specifically, which landscape are we dealing with? Do we have a thick middle that's just waiting for a crisis to take action, or have we actually lost a center that can help deliver reform? And then related to that, Peter said that unfortunately the academic community, he doesn't think has much influence over polarization. So I was curious if you could weigh in on what the academic community can do to improve polarization on this issue, but also more generally.
Great questions. We used to have, and we've had since the Greenspan Commission, many commissions that get together in a bipartisan way. Those have never been moved through Congress. The voting rules for Social Security is a supermajority of 60, which forces bipartisanship, which I think is actually a really good thing. I think you don't want a program to go 50 years without making changes. You probably also don't want changes every year. That's also very hard to plan for. We've seen bills on from both parties. One party's bill will be all benefit cuts. One party's bill will be all tax increases. I think there's groups of bipartisanship that are trying to form to create plans that reach a broader consensus. Whether they can get, any plan can get 60 votes in the U.S. Senate today, or what it needs in the House is very difficult.
Yeah, no, I agree. I think it's if we might have once had a sort of a normally distributed sort of political orientation of our elected officials, now we have an abnormally distributed sort of bimodal distribution. To what degree that's reflected in Americans' political attitudes? I think to a certain degree it is, but I think Americans still have a lump in the middle. But it's just very, very difficult given the general polarization in Congress. There's also, as Deb said, there's these thresholds. You have to have the House. You have to have 60 votes in the Senate. You have to have the presidency. That's going to be very, very tough to do. It is, and there's a whole variety of reasons for dealing with how our political structures are set up. But other countries have solved these things. The fact that we've gone 40 years knowing we have the problem and literally done nothing is, I just really think it's a sort of a damning, commentary on the governance we have. This is everything. Oh, this is a sacred trust. It's essential for this, that, and the other. And year after year, you do nothing. So it's people have a right to be a little bit ticked off about it, I think.
In preview for the next session, Jason and Kathleen are going to talk about a lot of the different proposals that are out there.
Great, we have a question right here, Karen.
Thank you. This question's for Andrew. Can you talk about the merits or issues about taxing investment income and having some of those proceeds go into the trust fund?
I'm not opposed to just general revenue financing of Social Security. I talked a bit about sort of the Australia or New Zealand system, which is these sort of flat dollar benefits, and those are general revenue financed. I don't have any problems with that. Where things get confused is, on the one hand, you have the rhetoric surrounding Social Security. These are earned benefits, so on and so forth. Well, the problem isn't, we may have earned the benefits. The problem is we didn't pay for them. If we'd all paid for them, the system would be going broke. But then the solutions are things that undercut the argument this is an earned benefit. I was looking at investment income, essentially going, lifting the payroll tax ceiling, things like that. So as policy, I don't have a problem. I think it's just, And I don't, even on the economic side, I don't have a strong opinion on whether going after investment income has economic costs that taxing wages doesn't. It's part of this, I just want something that makes some sense here. And we have a very incoherent way of thinking about the system, very incoherent policy discussions. So I'm not against it as such, but I think we just got to realize what are we trying to accomplish here, basically.
Okay, I think we have time for one more question. So right here.
So I want to posit sort of an extension to, I think, John's question, which is, let's say like someone's not 55, they're 45 or 35, and I think a question sort of I get a lot is, how should I think about this when I'm planning for retirement? Like, should I, how much money should I assume that I could receive from such a system if I were, collecting in 40 years or 45 years? And I guess my question is, how do you guys think about this problem?
If I were you, I would look at the funding gap for Social Security. Let's say it's 2-3% of payroll. Increase the savings in your 401k by 2 or 3% of payroll. If we end up raising taxes, in 2034 by 2 or 3% of payroll in order to pay higher benefits, then you reduce your savings by that. That's a way of sort of trying to hedge that risk. Obviously the younger you are, the bigger the uncertainty, but at the same time, you have tons of time to prepare. So I would just save a little bit more, and I think that kind of takes care of it. If you're a middle-class person, if we're thinking about the insurance aspect and the risks, then all bets are off.
We might have time for one more question. John, did you have something to say?
No.
Okay. Back here.
Wanted to react to something that Deborah said about it's not only the system, but you got to think about the people, and you got to look at things broadly. So you might be doing this already. I have faith in each of you. My question is, have you ever encountered folks in the organization, maybe not your organization, but others, saying, that's not my department? And I think that's just something that to remember as far as when we're trying to have confidence in the system, in the systems. And I'll say that maybe AI is going to help out, and it wouldn't be a first half of 2023 conference without a reference to that. But if that's going to be used, don't screw it up. And if you have other organizations you talk with, just remember, if you're already doing it, to have them, as far as the culture of the organization and maybe the organizational values, to really avoid saying, that's not my department, that's not my job.
Mm-hmm. One possibility, this is a little speculative, but to the extent that AI machines, call them that, and robots are going to do a lot of work, maybe the owners of those should pay into the system.
Well, with that, I think we'll end this session. And thank you very much. We have a little bit less than a 15-minute break until the fourth and final session. So thanks very much. And you'll still introduce the rest of the panel. Yes. I'll still introduce you, and then you can introduce the rest of the
Yes, but you can only just like read the first sentence or whatever. I'm not going to do either one of their full paragraphs. I'm just
Yeah,
gonna read the
yeah,
first sentence. So
I'm
you don't
sure.
have to do the whole.
Okay.
Nobody cares.
All
Plus, we're
right.
standing between people and
I guess. So we are very conscious of the fact that this is the last session before the reception following the event, and so we don't want to belabor things any more than we have to, but I think this will be a great session to end on, and certainly help us think through everything we've heard today and set the stage for what we think about after we leave. So I'm very pleased to introduce you to Molly Dahl. Molly is chief of the Long-Term Analysis Unit in the Labor, Income Security, and Long-Term Analysis Division at the Congressional Budget Office. In that capacity, she leads the preparation of the agency's annual population, labor force participation, and long-term budget projections. She also leads the work on the longitudinal microsimulation model used to project Social Security spending and revenues over 75 years. And I will turn it over to Molly, who will introduce the rest of our panel, which is going to follow more of a fireside chat type of model. So, yes. Thank you.
That's right. Before we get started, though, I wanted to thank CEPR and the staff. This has been an incredibly interesting and informative day. Hopefully we will continue that tradition. And has been incredibly well run, despite the near catastrophe of like a late meal, which is a crisis in such a situation. Handled beautifully and particularly and very well done. So thank you. So I have with me, oh yeah, I agree. So I have here on the stage with me Kathleen Romig, who's the Director on Social Security and Disability Policy at the Center on Budget and Policy Priorities, and Jason Fitchner, who is the Vice President and Chief Economist at Bipartisan Policy Center. And as Gopi said, this is going to be more of a fireside chat. They have assured me that it will be a fun fireside chat as opposed to a contentious fireside chat. So a lot of what I'm about to say in the introduction we've heard already, but I just want to, if anybody's joining online or slept through the whole first sessions. So we're talking about Social Security program, and the fiscal situation and outlook for the Social Security program is indeed challenging. We're talking about exhaustion dates within about a decade. And at that time, if we see an across-the-board benefit cut, we're talking about a benefit cut of potentially over 20%. There's a lot to discuss here. As Gopi said, we're standing between people in the receptions, so we want to go ahead and get moving. So Kathleen, I think you were going to talk through first some discussion points on payroll tax options and how we might reform payroll taxes. Jason, you're going to comment, and then we're going to go to you, Jason, to talk about benefit changes.
Yes. Hello. Yeah, I'd like to start by addressing a common misconception about the politics of Social Security, which is this idea that Social Security is the third rail of American politics. If you touch it, you will get burned. And I honestly don't think that's true. I think we need to be a little bit more precise. I think that it's very clearly true that if you cut it, you will face pretty severe political consequences. And we're seeing that right now. We saw it at the State of the Union this year. And again, President Biden raised the specter of Social Security cuts, not changes. And as Deb said, there's a lot of interest, in fact, in strengthening Social Security's finances. When you poll voters, it's consistently one of the top 5 things that they want people to want Congress to address. That was true in the midterm elections when there was an awful lot of more immediate things happening. It was still in the top 5. So people very much want a solution to Social Security. They want a strengthened program, but they do not want to have their benefits cut. And so with that, I want to present you a few payroll tax options, because that's the other side. You know, we talk so much about the benefit side of things, but sometimes these tax things are just not discussed. And so what I want to talk about first is something that's come up an awful lot today in our discussions, which is increasing income increasing inequality in general. We have increasing wealth inequality, we have increasing wage inequality, and we have increasing longevity inequality. All of these things impact people's retirement security. And so since we're focusing on payroll taxes to start, thinking about the increasing wage inequality. As Louise explained this morning, this is not something that the policymakers of 1983 expected. And back in 1983, the Social Security payroll tax covered 90% of earnings in the economy. And thank you for doing the slides, Jason. But that's really changed, you know? So look at this graph that the tax cap cut 10% of wages back in 1983 were above the cap. Now 17% of wages are above Social Security's payroll tax cap. And as you can see in the bottom line, about the same number of workers have earnings above that cap, but the gap between these two lines is growing because of that growing inequality. And so 7% of aggregate wages in the US economy is a lot of money. And that money is now not taxed as it would have been if the Social Security tax cap had stayed at 90% of wages in the economy. And as Deb said, Social Security's actuary has estimated that simply pegging it to 90% of wages in 1983 would have given us an additional 50 years of full financing of the program from here to 2075. We wouldn't be here talking about Social Security solvency had we done that in 1983. So I think that's really important. And we can still do it now. You know, we wouldn't want to do it all at once, of course, but the Bowles-Simpson Commission, a bipartisan commission about a decade ago, did look at an option that would have gradually increased the payroll tax cap to once again cover 90% of earnings in the economy, and then keep it there. They would have also replaced some of those earnings above the current cap, but not as generously as those earnings would be replaced under the current system. And that alone would close 20% of Social Security's long-term financing gap. So that's one option. That's a very popular option, by the way, the most popular solvency option when you poll voters. Another thing on the payroll tax side that we could do is broaden the base. One way to do that, of course, is bringing more workers in. I'm sure we'll talk about that later. But another is the types of compensation. And this is another thing that Louise brought up this morning that was not necessarily anticipated in 1983, that we see a lot more non-wage compensation these days than we did in 1983. So the rising cost of health insurance premiums as a percentage of compensation has doubled since 1983. The increase in so-called cafeteria plans that cover things like flexible spending accounts, those essentially didn't exist in 1983. Now 40% of workers have access to them. Those are not taxed by Social Security. And you know, if we did, if those were subject to the payroll tax as well, another bipartisan commission around the same era as Bowles-Simpson, the Rivlin-Domenici Commission, which Jason's employer convened, they suggested applying the payroll tax to those fringe benefits, treating them similar to the way that we treat 401ks. And on the health side, that would close 1/3 of the gap. And for the cafeteria plans, that would close 1/10 of the gap. And then finally, and most simply changing the rate. As Bill mentioned, the rate has been frozen in amber for the last 33 years, and that was not true historically. You know, as the program expanded, as we brought in new types of benefits, survivors benefits, spousal benefits, disability benefits, as benefits became more generous over time, as more people came into the system at the beginning, and we'll talk more about this legacy debt as well, but as more people came into the system, as more beneficiaries each year came into the system, we gradually raised taxes, and then boom, 1990, it hasn't changed since. If we simply changed the payroll tax rate by 1 percentage point, it chipped an additional 1% of wages, that would close 25% of the gap. And that was another thing that the bipartisan Rivlin-Domenici Commission proposed. And it wouldn't be a huge deal for most workers. For someone earning $50,000, about an average wage, it would be an additional $10 out of every biweekly paycheck. And the employer would also chip in another $10. So this is not something that's going to have huge effects on people's pocketbooks or huge effects on the labor force participation. We're talking about a fairly modest change. And if you've been keeping track at home, I just solved 9/10 of the problem. So it can be done. And this is through a pretty traditional, you know, keeping Social Security's traditional structures and not cutting a single dime of benefits.
So I was very fortunate they agreed to let me control the clicker, which means I get to move backwards and forwards as I please. keep in mind the context. So one of the things we want to talk about, this is just for OASI, the retirement program. The trust fund depletion date is now 2033. HI is 2031. When you start thinking about the combined programs, a lot of times the media talk about OASDI together. They are separate trust funds. The DI program itself is now solvent to 2097, so it's outside the 75-year window. But it's very sensitive to economic conditions. One recession, that number could be right back down to depletion date being quite early. If you used all of the trust fund reserves, basically payroll taxes that go for DI and trust fund reserves, for the DI trust fund, it buys you 1 year of retirement solvency, which is why the combined trust funds go depleted in 2034. This is the gap. That black line you see horizontally solid, that is what is called payable benefits. The line above that is what's scheduled. We're trying to pay if we don't make any changes. We got to make up that delta somehow. And there are basically two ways to do this in broad categories. Bring in more revenues, reduce outlays. That means reducing benefits. How you do that is the question. And that's what we're talking about today. So we're going to start with these big categories and move down to some more specifics, but that's kind of important. We have talked about the idea of what it means to delay, the cost of delay. These are the various depletion dates from the trustees' reports from 2003 to 2022, and I think we got some ones cut off, but what you'll see is there's a very narrow range, which for the last 20 years, we can tell you between somewhere 2027 and 2042 or so, the trust funds are going to be depleted. We've known about this for 20 years or more. We just haven't acted. And that's one of those behavioral economic insights where the problem always seems so far away. It's not urgent. Congress, of course, hasn't acted. We've seen Congress so far is very good at waiting until the last minute to respond. And I think that's something to keep in the back of your mind as we start talking about policy options, because if we think Congress is going to delay until the last minute, that kind of makes our options even smaller. Let's talk about the payroll tax for a minute. And we're just going to talk payroll taxes. We're not going to talk about other taxes. That's going to be like the third category. The cost of delay means the payroll tax increase, if we do it on the tax side, has to go up. So you'll see the tax increase. This is by percentage points from the 2012 trustees report, 2022, which was last year, but in the 23 report, I pulled a number out that says, what if we wait till trust fund depletion in 2034, which is what I think Congress is likely to do. That means we would have to raise payroll taxes by 4.15 percentage points. If you recall right now, you're paying 12.4. You pay 6.2, the employer pays 6.2, so this would be split evenly. But that means you'd be paying somewhere near, 16.55 percentage points. Add in Medicare taxes, which we haven't talked about solving Medicare yet. You're basically going to have a payroll tax rate of 20%. Add that if you're a self-employed individual, so you're paying both the employer side, that's 20% on you. Add in your federal income tax, which could be 35%, maybe 37%. If Biden gets his way, maybe it's 41%. Now you're getting really high. If you're in California, where they don't allow you to keep any of your income, your tax rate now is well over 60% at the margin for your high tax earners. That has a big disincentive on innovation, on small business creation, and anywhere along that sort of tax rate will have implications for labor. We've talked about the tax elasticity. We don't know, it does depend, like where you are in the income level, where you are in your career, but it will have some effects. And so one of the concerns I have when we talk about revenues is we should start thinking about this differently than just payroll. Because as a tax economist, I was always taught and told my students, tax the things you want less of, subsidize the things you want more of. If you're going to do something on tax policy, try to make sure you don't change behavior, unless you're trying to change behavior. You want to tax cigarettes to change cigarette behavior? Fine. But if you want to encourage labor, you shouldn't tax it more. And I think that's my concern on the tax side, is we are getting to the point where you start doing little dollars here, they add up to big dollars over time. So when we think about the tax increases, we're going to be a little bit more novel, I think, in our third category discussion about what we might be able to do to raise revenues. But you can do tweaks. And the point of this is, and what Kathleen started doing, is she started doing one slice at a time to get up to solving 90%. We are losing our ability to solve this problem the longer we wait. In 2008, when I was the Deputy Commissioner of Social Security, I followed Andrew. And I was the Secretary of the Board of Trustees, so I signed 3 reports and worked on the working group. Back in 2008, and I'm not saying this was my policy option, but if we had just eliminated the taxable maximum for Social Security payroll taxes, that would have solved the 75-year solvency issue. Now you're getting about 40 to 60%, depending on whether you want to do a 75-year period or you want to count the 75th year of solvency. You're not doing it alone. She mentioned some things about getting 25%, right? We're getting piecemeal stuff. The point is, we probably can't do this all now on the tax payroll side. Now, they're going to be able to do it all on the benefit side either, which we'll get to next. But just trying to solve this on the payroll tax side is going to be a heavy burden on workers. Another individual last panel session mentioned AI. If AI is really going to be the transformative thing of this next generation, how is that going to impact labor? Not just low-wage labor, but even middle-class labor like accountants. You can see in reduced jobs, is it going to be productivity enhancing, or is it going to replace jobs? We don't know yet. But my point is, if you start making labor more expensive, you're going to have less of it. And that'll ultimately end up being less money going into trust funds, not more.
I like how you chose accountants and not economists, but
AI is not smart enough to replace us because we don't even know what the answers to our own questions are.
we can talk more about that later. So then as Jason alluded to, we talked through, Kathleen talked through quite helpfully some discussions on payroll tax options and how we might move the needle on Social Security finances on the payroll tax options. Jason, can you talk us through some thoughts you might have on benefit changes?
So this is when you think about benefits, I'm going to pull something Bill said, because he's one of the only other people besides me who mentions that this is an insurance program. And I really appreciate that framing, because you were able to highlight things that I think are getting lost in the debate. When you think about insurance, there's a lot of public finance professors in the room. What do we insure against? Things that are high cost, low probability events. Right? Things like your house burning down, which some people know about personally, car accidents, things you can't necessarily afford to save for yourself, so you buy insurance for it. When we think about the old age insurance program, the whole idea was you had people who were outliving their savings because they had longevity risk, and they basically, it wasn't supposed to be a retirement program. It was supposed to be an old age insurance program. And we added other things in along the way. But it's now morphed into this sort of retirement program. And it wasn't designed that way, and that's why the cost has gone up. But we are now paying a heavy premium for that insurance. And you're paying it at different equitable rates. Different people get different benefits by race, by gender, and by income. So it is no longer necessarily definitely fair. Now you get to the benefit of adequacy issue. Again, going back to this chart, this is the gap we have to make up. So do we want to reduce that dotted line and bring it down a little bit and go back to an insurance mode? And we can do that. Some people have suggested a flat benefit model. Some have suggested taking higher income benefits, reducing them to bring up lower income benefits. That'll be a way to actually make it, again, more of an insurance type model. So I think we need to start thinking about how we design the program as an insurance program to make sure it has adequacy for people who need it, but doesn't pay overly too much to people who don't necessarily need it, even though they've paid into it. And if we start going with general revenue transfers, that's going to be probably even more important to think about what a flat benefit structure looks like. There's been a discussion of means testing. So we do not means test Social Security today, but we do have a backdoor means testing. We tax benefits on your 1040. If you're getting Social Security benefits that make over like $25,000 a year, we can tax up to 85% of them on your 1040. My guess is at some point on the revenue side, they're going to tax benefits 100% for certain income levels. But that's a way to avoid means testing, but still sort of mean test. But think about spousal benefits. Again, you brought this up, Bill, as well. We'll probably do something on the spousal benefit side to make sure it's more equal, and that will sort of reduce the outlays a little bit. The retirement age, one of the ones that comes up on the conservative side is raising the retirement age. This can be a benefit cut on one side, if you think about it, but I'm going to give you the flip side. I think, Karen, you mentioned that retirement age increase is a benefit cut. For people who are living longer than they are assumed to have lived, if you don't raise the retirement age, it's actually a benefit increase that was not planned for. So we need to think about what the retirement age means for certain people who are living longer than the program is expected. Higher wage people, better jobs in environments which is air conditioned, have a retirement savings plan outside of Social Security, and probably figure out some way to reduce the benefits for them and helping those who at the lower end have higher benefits. That kind of shifts that debate a little bit. But when we talk about the retirement age, it's not necessarily a benefit cut for everybody. Right? It basically could be a benefit increase if we don't change it for certain people. So keep that in mind. So I think we have to do something on the retirement age, but we've also lost the ability for that to solve the problem. When I was going through Steve Goss's actuarial numbers, he's the chief actuary for Social Security, and going through his provisions, and there was ones to raise the retirement age, and there's various ways you can do it. You can do it by, every 3 months you raise it by, every year you raise it by 3 months, and you keep going forward. You can tweak it. Basically, you can solve roughly 40 to 60% of the retirement age side. As soon as you start tweaking that, though, you get down to about 20, 25%. We mentioned the 83 reforms, the very first panel discussion today. 1983. What year is it now? 2023. How many years is that? 40. We are still implementing today the increase in the retirement age. We haven't got to 67 yet. 67. I thought it was going to be 2027.
2022.
Is it this year it does it?
Last year, yeah.
All right, 40 years then. Took 40 years to do it. Do you want to take 40 years to do the next implementation? If you do that, then you got to do more on the different benefit side or on the tax side to make up for it.
You're both right. One of you's doing it by age 62, and one of you's doing it by age 67.
I'm doing 67. Okay, so 67 is what I was thinking of. That's the full. All right, so it still goes up to 67. So that's the nub, though. So if you're trying to solve this, these numbers get bigger the longer we wait, and the more we start tweaking to try to solve the problem. So we are at the point now we've delayed so long, I don't think we can just do this on the tax side, payroll tax side. I also think we can just do it on the benefit side. Mm-hmm. When we get to 2033, 2034, and someone says, oh, we can just raise the payroll tax by 4 pennies on the dollar, you're going to have Republicans say, that's a 33% tax increase, and they're going to start adding up all the taxes and get to your 60% marginal tax rate. You want to think you're going to have Congress? Can you imagine any Congress voting for a 25% benefit cut for Social Security across the board? I can't. The point here is this is the default. If nothing gets done, and we had a question of what actually happens if we get to this point, if we're there, Social Security has no borrowing authority by law. It can only pay out in benefits what it brings in revenues, which means either benefits get cut or they get delayed until enough cash comes in to make full payments, which would still be for people a cut because they'd be getting a delay over the course of years. The default is not a tax increase. The default is a benefit cut. And I think we need to make sure we tell people that, because if they think that this is going to be just solved automatically, they're going to be wrong. And it's very important we consider that. So that's why I think the benefits have to be included in this conversation, but we have to do it in a way that's equitable, fair, and holds those harmless who need the most assistance.
Yeah, please.
I'd like to address the for retirement age increase issue specifically, and I have 3 points. One of them related to what Jason was just saying is that we want to avoid this 25% across the board benefit cut, and that's why we need to raise the retirement age. Well, what is raising the retirement age? So there's a proposal now, live proposal from the Republican Study Committee that would raise Social Security's full retirement age to 70. What does that mean? That's a 20% across the board benefit cut. So to avoid the 25% across the board benefit cut, why don't we instead implement a 20%? It doesn't add up to me. The other second point is one that's been made many times today, is that the justification for raising the retirement age is people, like Bill said, people are living longer. Which people are living longer? Where have these longevity gains happened over the last 40 years? Well, many people aren't living longer at all. And in fact, with these deaths of despair, we're really seeing some people living shorter lives than their mothers, fathers. And we are certainly seeing that the increase in longevity is concentrated at the top. If you're concerned about that, then I would propose that maybe you think about benefit cuts that are targeted at the top and not an across-the-board benefit cut that affects everyone. And then my third point has to do with, how much is this actually going to help Social Security solvency? Like Jason said, and other people have made this point as well, we're not going to implement an immediate benefit cut. It's going to be gradual. If anything, I think if we do raise the full retirement age again, it's going to be even more gradual than it was in 1983, based on what we're hearing now from Vice President Pence, who has proposed a full retirement age increase, Nikki Haley, and other people. They're talking, the Cassidy King bipartisan commission, not commission, but gang, I guess.
Working group.
But they're talking about not making it effective for 35 years or more, for a generation. And so that means you're not going to see a dime of savings from this for a whole generation. So I think we're going to have to look at tax revenues to solve the immediate shortfall. We're probably going to be looking at general revenues, and we'll talk a little bit more about that. But benefit cuts, just mathematically speaking, cannot be an important part of the short to medium term way to fill the gap. It's just not going to happen politically.
This is where the text on here is the numbers reflect tax increases and benefits in isolation. The odds are there's going to be some combination of benefit changes, tax changes, and then we're going to talk about the third potential options in a minute. probably because of politics. And one of the things, I also work in the retirement security field. I talk to financial planners, and they're always used to talking to their clients about market risk and sequence of return risk. And I'm telling them they got to talk to their clients now about political risk. Who's going to be in the White House in 2033, 2034? Who's going to be controlling Congress? What is the politics going to look like? I mean, we've been seeing it get worse, not better. Are we going to have more grandstanding going into trust fund depletion? There was Peter Orszag didn't want to answer that question that you asked, Mark, about what's going to happen because he's not sure what's going to happen with this debt ceiling issue. This is one of those things where if the Democrats wanted to do it on their own after the last midterm election, Bernie Sanders said, let's raise it to $100 trillion and be done with it. They didn't want to do it, even though it was after the election. This becomes our self-imposed crises we put on by various rules. And we're going to see the same thing, I think, happen as we get closer to trust fund depletion date. There's going to be a lot of posturing and a lot of divide, and we'll see what they do to react. But to your point, the longer we wait, the bigger the delta, but no one's going to interact and institute the delta all at once. They're not going to put in a 3% tax increase or a 20% benefit cut. They're going to do something moderate, which means you're pushing off the program's long-term changes for 40 or 50 years, and you still got to make up the gap in the short term, medium term.
And so I think this segues quite nicely into the next segment of the conversation that we had talked about, which Jason, you've alluded to, and Kathleen, which is talking about some less traditional changes to the program that we might see that might help improve the financial situation. And so, Jason, I didn't know if you want to talk about investment
Let's
trusts.
save that one for the end, because that'll be fun.
Okay, we'll save that one for the end. So then, Kathleen, I didn't know if you want to talk about some non-traditional sources of tax revenue.
Yeah, one thing that that has come up a number of times today is bringing some forms of general revenues or other forms of tax revenues into the system. And this actually is an idea that's been around for a while. That there are, there's one, Social Security is often discussed as part of a three-legged stool of retirement security, savings, pensions, and Social Security. And likewise, some people have recommended that the program itself be 1/3, 1/3, 1/3, instead of, it's essentially paid for by payroll taxes now with a bit of taxation of benefits, half and half on employers and employees. Some people have proposed we do 1/3 from the employer side payroll tax, 1/3 from the employees side, and then 1/3 from general revenues. And part of the policy justification for that is that Social Security has a pretty significant legacy debt, and that comes from the early years of the program. This program was famously first implemented in the middle of the Great Depression, and so they wanted to pay out benefits as soon as possible. They had only collected taxes for a couple of years when they started paying in those first benefits. Those beneficiaries got benefits for the rest of their lives. They paid in very little. And so the legacy debt that we're still paying now is a big part of the gap that we're seeing now. And so some people say, well, why aren't we using other novel, actually Peter Orszag, one of his proposals in the past in his book with Peter Diamond was taking an enhanced estate tax and putting that revenue into Social Security to help pay off that legacy debt. Another thing is just, bringing general revenues in general. And I think it makes sense to think about it that way. As we've discussed, Medicare, another incredibly popular, also social insurance program, it has significant general revenue financing. And that has not undermined political support for the program. That has not undermined people's feelings of ownership of their benefits or the fact that they earn those Medicare benefits just because it has general revenue financing. So I think we will, out of financial necessity, see general revenues as part of the solution, and I think it makes sense as a matter of policy.
This is one where 15 years ago, my choice architecture would be much different than it is today. I do think we've lost so much time that we no longer are going to be able to solve this within just the Social Security system itself. Peter mentioned that on payroll taxes or benefit cuts. So we've been having conversations about, are there ways to bring the middle together again on other forms of revenue? And without endorsing, we're just going to talk about what you could potentially think about doing, right? So one is an estate tax. I think when they had the $1 million exclusion, that was way too low. 13 for a single, 26 for married might be too high. There's probably something in between. But that gets into questions about what the incentives effects are for business. If you're trying to find a revenue source, you want one that you can tax, that won't change behavior and raises a lot of revenue. I'm becoming a bigger fan of a financial transaction tax. And there already is a model in place right now. When we sell, if you have E-Trade or Fidelity or Vanguard and you go sell a stock, you pay a very, very, very small percentage that goes to the SEC. It's right on your trade afterwards. No one really knows it's there. I keep bringing it up and people stare like, I'm paying what to the SEC? Like, If you sold $10,000, you might have paid 46 cents. It's very small. You can start taxing these things for a financial transaction tax. The higher volume trading would get taxed a little bit, on volume more. That could be a revenue source for Social Security. And again, don't think of these as being something that has to solve all of it. You're now trying to solve pieces. There's been concern, though, and we've heard this about whether or not if you leave the financing and do something outside Social Security, will that ruin support for the program? To Kathleen's point, I don't think so. I think it's still, as long as there is some tie to an earned benefit, that you still have support for the program. We've heard the phrase, programs for the poor, poor programs, so not turning it into welfare. So having some connection to the payroll tax still makes sense. I'm just fearful that we can't rely on the payroll tax anymore to increase it because of the labor effects. So trying to find something outside of it. So a financial transaction tax, a carbon tax, looking at the estate tax. It also helps distributionally if you're thinking about who you want to tax. If you want to tax people on the higher end, those who have higher incomes and have higher assets and do higher trading and more volume trading would pay more into the program. So you wouldn't be hurting lower income people and you wouldn't be affecting labor force incentives either. I think we need to start being a lot more creative about how we think about this because we kind of run out of time.
So then related to, or I guess I should say less related actually to the obvious connection to Social Security finances today, and this topic has come up, is one of the number of workers in the country and immigration issues associated with that. So I didn't know if either one of you had any thoughts that you wanted to share on that.
So I've been talking with a colleague about trying to do something on the Social Security side. Maybe Andrew, we should talk on the side too. We're talking about tax increases, benefit cuts. What if we sort of flip it a little bit and look at labor force participation and the decline in labor force participation? What would we have to get back up to for that level to basically be enough to fund Social Security on the payroll tax side? Like, how many more workers do you need to have come back in, whether it's through immigration or just labor force participation? That allows us to have a different conversation about why aren't folks in the labor force? Is it childcare? Is it paid leave? Is it discrimination? Is it? That allows me to have a much different conversation that would help Social Security without talking about Social Security reform. So we're starting to noodle a little bit on what this might mean for thinking about getting workers back in. And someone earlier asked about immigration. We do need to have smart immigration policy. It is interesting thinking about, again, the polarization in this country. I still remember a time when Republicans liked having people show up here who wanted to work. You mentioned the idea about people tying to work, but work is a very important thing. Both parties love jobs. People love jobs. Jobs are great. We are now seeing this party divide in which people who want to come here to work and make their life better, because this is a country that allows and affords that, are no longer welcome by a party that used to welcome them. I don't know how we go back to that old Republican Party that says we want people to work. Smart immigration does help the trust funds, especially in the short end, because they pay payroll taxes, that helps the financing, and then overall, you basically have the actuarial, but it helps up front. We need to have smart immigration policy. We need to have smart labor policy and talk about what that means for labor force participation and how that could help trust fund balances.
I agree with everything Jason said. I also would add, immigration does help with the worker beneficiary ratio in the short run. It also helps in the longer run too, because on average, immigrants have a somewhat higher birth rate than native-born Americans.
Is it time to talk about investment trusts?
Let's have some fun.
Okay. So one of the other points we had discussed before coming here today was, and you had mentioned Cassidy King in this issue of investment trusts, and so I just wanted to tee that up for you.
And I don't know if other people know of it, or if that's more of an inside DC thing. Should we explain?
Probably inside.
Okay. Should we explain it? Do you want to explain it, or do you want me to?
Well, let me just tell you what the thought process is.
Yeah.
There have been proposals in the past to when Social Security was getting a surplus, allow them to invest in that surplus into equities, or at least marketable bonds. Right now, by law, they can only go into special issue treasuries, which are treasury bonds that pay a market rate. That's all they can do. So there's no equity premium. What if we allowed Social Security to invest trust fund assets in something besides treasury bonds? A diversified portfolio, which any sort of pension plan does as a fiduciary. We've kind of lost that ability to do just that because the trust fund balances are depleting. So an idea has come up about creating an investment trust. Do not call it a sovereign wealth fund, please. There's no sovereign, right? This is basically a system in which you have a trust that is independently run and managed.
There's also no wealth.
There will be creating wealth, in which the sole beneficiary is the Social Security trust funds. right? So it's not going to each beneficiary, it goes to the trust fund, so it pays back into the system and helps fill up. Again, we are trying to solve this gap, or at least part of it, with this trust fund. There is a model going on right now. It's called the Puerto Rico Pension Reserve Trust, which I am the chair of, and which Andrew helped set up and suckered me into running the thing. It has surplus money coming in right now from the bankruptcy of Puerto Rico's pensions. Now they're refinanced. There's basically about $1 billion a year coming into the trust. There is no withdrawals from the pension trust for about 10 years. So you get $1 billion a year, that's $10 billion over 10 that gets to grow. It's a defined pension plan that is closed, it's a closed plan now. As the current workers who are paying for current beneficiaries start to retire, who's going to pay for them? The payroll taxes start declining in revenues, the pension trust makes up the difference until the last beneficiary then dies, and any remaining revenue goes back to the Commonwealth. The sole beneficiary of the trust is the Commonwealth. They can only use it to pay benefits. There is a deed I had to sign, there's a plan of adjustment, there are articles which they specify how withdrawals can be made, who can make them, who has to approve it. Very complicated system designed for the public choice problems you're already thinking about now that having government invest in the market. If we are thinking that Congress is going to do nothing for 10 years, what is the most likely option they will do in 10 years? We've heard it from just about everyone here today, intergovernmental transfers. But what's that a word for? Borrowing. That just means more borrowing. That is now my baseline. I have to make up roughly $250 or $300 billion a year I am short. If you're just going to borrow that money 10 years from now, why don't you just give it to me today? Let me start investing it. For scoring purposes, no equity premium. What I want is an upfront payment that is based on treasuries, so that anything above and beyond that, I get more money up front, I don't have to go chasing equity. But then I can start investing that money today, and I've got 10 years before trust fund depletion, and withdrawals have to start coming from the trust to make up the difference in the payroll tax. I'm not raising payroll tax rates, I'm not cutting benefits, I'm trying to make up the gap. This is where you start thinking about how this might work structurally, budgetarily, legally, independently. If you start doing like a payment, $300, $400 billion a year, each year for 5 years, then that money gets invested. It's not a one-time $2 trillion shock in the market. It gets absorbed. Independently managed, RFP, transparency. We've got stuff on Puerto Rico I'm happy to share. I've got 5 slides I can give to Mark or Gopi, and she can share them. John's already got a copy, so I'm going to get comments from him. But this is something we have to start being creative about, because if you want to avoid tax increases, benefit cuts, you're going to have to be more creative. And one idea is an investment trust. Mm-hmm. Now, it is still borrowing. Don't get me wrong. Now, we can just basically say we're going to assume that if we borrowed money in 10 years, that's just debt that keeps going. And my concern with that is I do think at some point, whether it's tomorrow, 2 years from now, 10 years from now, we are going to have a debt issue. Everyone's been calling for it, and so far it hasn't happened. But it doesn't mean it won't happen. Our debt to GDP levels looks like it's going to be unsustainable. Do you want a system in which you're making up that gap every year with additional borrowing with no end in sight? I don't think we do. And I'm going to be happy to have a bottle of wine out there and talk to all of you about the investment.
Yeah, I guess I would note, I noticed one word that you said when you were describing the Puerto Rico system, which is surpluses. You're investing surpluses. And when we talked about this last seriously as a country, it was when Social Security had annual surpluses, and now we're in deficits. And so we are talking about borrowing. And when we're talking about accruing this investment income over time, well, that money's locked up. We're not going to be using it to fill the gap. We're going to be waiting for it to accrue these returns. And so then that means even more borrowing. So I think when we think about this in today's context,
it should be, if you do it right, it should be less borrowing. Because if you wait 10 years, you're going to be borrowing $250 or $300 billion every year in perpetuity, as opposed to giving me 5 years worth of borrowing and then letting me invest it. Then I make up the gap.
Sure. I guess to put it in more concrete terms, there's this bipartisan group of senators working together now to think about Social Security in different ways. And I think it's great that they are doing this. And what's been reported is they're talking about borrowing $1.5 trillion and then locking it up in an escrow account and that's what they call it. They don't call it sovereign wealth fund. They call it an escrow fund. Locking it up in escrow for 50 to 60 years, at which point they will take the principal and the returns and repay the borrowing and also use it to fund Social Security in perpetuity. So this is, bringing more general revenues into the system. You know, these borrowed funds would be general revenues, which is something, like I said, I'm open to. However, we're talking about a pretty massive amount of borrowing. You know, not only the 1.5 trillion upfront to invest, but also during those 50 to 60 years, funding that gap in the meantime. So it's not clear to me that this would fly, you know, in a country where we're not even sure if we are going to pay the debts that we've already accrued, whether we are going to take on this massive new amount of debt. But if it is a way to break the impasse, then, you know, maybe we should think about how we could do it. I mean, I think we do have an impasse between, you know, people are pretty hardened in their positions on the traditional options, on the payroll tax options and on the benefit cut options, and there are limitations to those options. And so I think it's good to start thinking about different ideas, but I think the major drawback to, well, there are few, that's one of the drawbacks to that. But that the massive amount of borrowing would be one that would give a lot of people.
And you could
pause.
finance it with a financial transaction tax instead. So there are ways, but I think one of the issues we're going to have problems with thinking about solvency is I do not think Republicans are going to go back to an era which they're going to allow payroll taxes to be a surplus used that goes into treasury bonds that just finance the other part of government again. So I think those days are long gone politically. So we're either going to be a pay-as-you-go system going forward completely, and you're going to have to adjust payroll taxes and benefits to basically be solvent each year. There's not going to be a surplus. Or you got to be creative and create some sort of wealth through an investment scheme that does allow you to have a trust.
So let's talk about time frame for a minute. So Jason, you were just talking about solvency, and in the 1980s, for instance, there was a discussion. The discussion was largely centered around 75-year solvency, and that was the time frame on which people were focused. As we've heard throughout the day, the situation then was very different, and the challenges that the Social Security program was facing then were very different from what it is facing now. And one of the other things we've talked about is when you're looking out as long as 75 years, compounding in reasonable differences or relatively small differences in assumptions about fertility or GDP growth or what have you can make a huge difference in what this gap that you're seeing 75 years from now. So, but there's less uncertainty as we come closer in, which is both for good and ill, less uncertainty as we come closer in. And so should we be thinking about something that is different from a 75-year window? Should we thinking about 25 years or something shorter like that?
Again, if you had asked me 15 years ago, I would have said no. You asked me today, the answer is yes, because we haven't done anything. We need to figure out what, again, we can reduce the barriers to getting some sort of action on a bipartisan basis. And if that is trying to get something that gets the needle in the right direction, so we get 25 years and we start showing improvement, I think that's a good step. And again, the idea to take, for example, payroll tax. If we decided it needed to go up 4 percentage points and that was 75-year solvency, then why don't we start with raising it 0.1% each year, get 25 years in, and then as you start getting to year 20, maybe you do the rest of it because people are already used to that 0.1% increase and they're not going to notice it, so you then do it at that point in time. So I think we start thinking about how we actually can get over the starting line before we have to worry about getting to the finish line. And we can't even get over the starting line right now.
Yeah, I agree with that. I mean, as Peter pointed out, predicting the future is really hard, and we don't really know what the 75-year gap is. And so we're not going to solve for the 75, I mean, let's not kid ourselves. We're not going to solve for the 75-year gap, even if we try. We just don't know. There's way too much uncertainty here. But also, you know, I thought Bill raised some really good points, too, about how much things have changed since 1983. You know, when you don't legislate on something so important for 40 years, then these trends overtake you. Like the changes in longevity by income, for example, that the 1983 legislators did not account for that because they didn't know about it. But we know about it now, and we've actually known about it for some time now. Like that report that Peter did, I think was like 15 years ago. So we've known about this for some time, but we didn't grapple with it as a country. How are we going to deal with this differential mortality? What are the implications of it? And, you know, and other things too, you know, again, Bill bringing up with different patterns in marriage and women's workforce participation and caregiving. Those things are not well accounted for in our system. It's a very archaic notion about, you know, a male worker being the higher earner, the female worker taking a long time off for caregiving. That's true for some families, but for a lot of families, it's not. Where there's higher divorce rate now than there was back in the 1930s, or just people not marrying at all. You know, and these are benefits that are based on marriage. You know, and also with caregiving as well. That's really changed. With women's earnings are often much more similar to their partners. And so I think we need to think more about those trends by gender as well. And when you don't legislate for 40 years, you have a very different labor market, very different caregiving, very different demographics and economics. And so it really makes sense to actually do it more often. I think we should do it more often.
Yeah, I was sensitive to Peter's comment about you got like this once every 30, 40 year time frame to make tax changes or benefit changes, that you need an event to do it all at once. But then also, again, the only thing I'm certain about in 75 years is I'll likely be dead. And you start seeing the progressivity changes, technology changes, environmental predictions are hard, especially when they're about the future.
Yeah, exactly.
So maybe we are smarter thinking about this in 25-year chunks and making progress. Because again, we need to get over the starting line, and that's been the hardest part. I want to switch to something just because I want to get in, because we have a little bit before we have to go Q&A. We've been having discussions about the politics and how hard it is to get people to come together, both culturally and politically. But there are ways to start. And Deb's at AARP, which they usually don't want any sort of benefit changes. It's hard sometimes to get to the table on things, but they've been a really good partner on a lot of issues, including the one I'm going to talk to you about. Kathleen and I have talked about this. There are things we can do to help people in retirement on the framing side. And Jay, we brought this up this morning, so I want to just do one quick thing, and then we'll sort of go back to this. Claiming age is really important, but it's confusing. Nearly half of Americans mistakenly believe that they claim early, their benefit will automatically go up once they reach the full retirement age. Communication is poor. Again, we talk about the early eligibility age, and when I was at the agency, I would go do surprise visits to field offices. And I would ask people, why are you here? Getting Social Security. How old are you? 62. When do you think you're going to die? 82, 84. Oh, so you have enough money to last 20 years in retirement? No, I didn't say that. They paused. Somehow thinking 62 to 82. 82 is the number that was in their head, but they didn't think that was 20 years of retirement. They're not thinking about that. So there is actually now legislation, bipartisan legislation, which we've all worked on and supported, that would actually change how we talk about the claiming age. It is still the modal age people claim, 62, right? 9.5% claim at 70 plus, but almost 30% claim at 62. It's the most popular age. What if we change the name? We're no longer going to call it the early eligibility age. We're going to call it the minimum benefit age. Full retirement age. Peter called it the normal retirement age. There's normal and there's full. What does normal retirement mean anymore? What does it mean to be fully retired if you're working part? What does that mean? We're going to call it the standard benefit age. And retirement with maximum delayed retirement credits. That's a mouthful. How about maximum benefit age? Imagine you're now a beneficiary walking into Social Security, and so you're 62 and someone says, oh, you're here to claim your minimum benefit. I'm sorry, what do you mean minimum? Can I get more? How do I get more? You just started a discussion. I'm not saying everyone can claim at 62 or can delay and claim at 70. People need, but having that conversation is so important. Even if it means delaying claiming by 2 months or 1 year. This is the administrative stuff we were working on 10, 15 years ago that we're now starting to see in legislation, and it's bipartisan. We can start doing this. Maybe we can start getting over that start line on the other stuff. So again, I work for the Bipartisan Policy Center. It is the only organization registered in the District of Columbia with the word bipartisan in its title. As an economist, it's either a supply problem or a demand problem or both. But it tells you how hard it is to get some things in Congress done right now. We are making progress. We can start the process along. I think that's why, going back to 25 years, we start moving the needle a little bit. Momentum, right? It's easier to push something that's already moving than it is to push something that's stopped completely. And this is the way we're doing it to start.
That's just because CBO is nonpartisan. That's
And it's the Congressional Budget Office. It's not even in your title anyway.
Yeah, fine, fair enough. Points well made. So now we get to turn to questions from the audience. So let's go ahead with questions. Don't scratch your head, you might get called on. Go ahead, go Pete.
So I wondered, this is kind of related to the window and should it be 75, 25 years, but could you comment on things like the Trust Act, which would trigger some kind of, I think they called it a rescue committee, if the trust funds were projected to be insolvent in like a 14-year window, and would that help us get to a point where we're making incremental changes, or is that?
Want to go first, or should I?
I honestly think it's a weird idea. Like, you're a United States Senator. you're passing a law to make yourself pass a law. Like, just propose something. If you want to propose something, propose it. And let's just do it through, we have an ordinary process, we have a committee structure, we have ways of doing things. Just do it. Like, I could see if I were calling for a commission, but why would a United States Senator be calling for a commission when they actually have the power to legislate on this? I don't understand it.
I think one of these, what it does is it raises awareness of the issue for the public. The problem is it's usually designed in a way that it fails. And you can see the Simpson-Bowles Commission and others, Congress still wants to be able to vote on it, but they don't put power in the hands of people to do it to actually make a decision. So if you're going to do some sort of trust act type thing, it would have to be something that says, okay, if they get it done, it goes automatically to the floor of the House and the Senate, and it's an up or down vote. That would have to be part of the act. Otherwise, you're just wasting time. And we've had discussions amongst many of us in this room about whether or not we got asked to serve on one, if we would. And the answer is no. Because I think it's a waste of time the way they set it up. It's not set up for success, it's set up for failure. And to your point, this is where, when are we going to have politicians have the courage to actually make reform? And that's the biggest problem. There's two down here.
Right here.
And then Bill.
I'll pass my time to John first.
Well, Jason, I have not, Jason sent me stuff on Puerto Rico and his investment trust idea, and I have not had time to look at it. But let me ask the following. Say I was short of money, and I had an idea, I'll borrow money and invest it. And that will make me less short of money.
Right.
Maybe. So there's certainly risk of doing that, and the risk that I will actually be in worse shape, not better shape, from having done that. And so I'm just trying to figure out whether your investment trust, is it kind of based on a stocks for the long run kind of argument that I'm borrowing money, investing in equities, and in the long run I'll certainly be ahead, which, by the way, that's not what I subscribe to. But tell me, am I going wrong here? But it just, what's bothering me is it doesn't seem to apply to people. That is, I don't think somebody who's short on money can get ahead by borrowing and investing. So why can the government or Social Security get ahead with what sounds like that strategy?
So I think part of this, when you think about it, is one, when you think about the pension plans for state and local, they've been banking on the equity premium. That's where they got in trouble. So basically they'll say, hey, we'll borrow, and I'll give you 6%, John, for $1 today, because I guess I can make 10%. Right. And they don't, and they're worse off. So the way the Puerto Rico pension trust was set up is the math works if we return a 4.5% nominal on average per year. I don't have to chase equity premium. Right now I'm doing it on government paper alone. Now, so the upfront, the discount rate, if John Studero's not here anymore, he left, the discount rate is very important how you set this up, right? CBO will not score an equity premium. They're just going to basically say it's going to be basically government bonds. So you have to have the discount rate separated so the upfront money's right. The second thing is the borrowing. Now, for the unified budget, it's borrowing. If you pull out Social Security and think about it separate from it as off budget, the money going in would be basically additional revenues. That would be its revenues. So it'd be like me telling you, John, I'm not borrowing, I'm giving you $1.5 trillion to invest. And that'd be like you would invest if you were an individual. So now you're not borrowing to catch up, you've been given money to invest to get ahead. And so this is where when I talk about the investment trust, I don't think, my baseline right now is that the federal government is going to bail out Social Security with borrowing.
So why not borrow now instead of borrow later?
Yes, and have that be a gift to Social Security, if you will. Yeah.
I understand.
Okay.
So why not create another tier of another age tier? Why not have a super premium benefit level at age 72, 73? I mean, look, we did it with IRA withdrawals. We've pushed that out.
Oh, like right? A later, like your monthly benefit keeps going up?
Yeah, well, you could have another tier. If your maximum benefit today was at 70, maybe you make the maximum benefit be at 72. Would that
well, I
make
think
a difference?
Jay's graph this morning was really telling, showing us that it's mostly high-income people who are doing that. Yeah. So I guess I'm not really that interested in helping high-income people maximize their Social Security benefits. That's not one of my highest goals in doing this kind of work. I think if anything, I think if we are looking toward benefit cuts, I'm looking more toward how can we address this rising inequality? How can we, have higher income, higher lifetime earners contribute more to the system? Or if we're cutting benefits, then maybe trim benefits for higher income workers. So yeah, I guess I don't really see that as a solution to what we need.
If I might just say a rejoinder on that, it's not clear to me that you would be helping high-income people maximize their benefits, at least from a lifetime benefit standpoint.
It would be neutral from a lifetime.
They would perhaps be actually kind of stupid to do it. But if they're going to continue to work because work provides other benefits, right, that
it would be
people wanna stay
actuarially,
engaged.
according to the current formula, it would be actuarially neutral.
Yeah.
So with respect to monthly benefits, it would be a higher benefit. But over the course of an average lifetime, it would be a higher benefit. But because of this rising inequality in longevity, a higher income person who is more able to delay their claim, as Jay showed this morning, would actually, on average, live longer than average. So it actually would be maximizing benefits for higher income retirees, which I think is the opposite of the direction where we should be going.
So the head of the organization has a question, so we're going to go to Mark.
Is that all right if I ask a question? So I know I've asked more than my share of questions. I apologize. But I love this stuff so much. So I guess I just have a question. So we're in Silicon Valley. And in Silicon Valley or near Silicon Valley, there is a disproportionate share of the ultra wealthy people in this country. And suppose that one day, one of those individuals woke up and just decided, you know what, I view this, how we deal with this, as a threat to America's economic vitality. Like, it's kind of amazing if you look over the last 30 years how much better the US has done economically than the typical industrialized country. We've done poorly on inequality, all sorts of ways, but just in terms of economic growth, really. So suppose that no view on should it be tax, should it be benefit, but you just wanted to, you had your billions and billions of dollars and you wanted to help your country because you love your country. I'm just trying to think, I guess you three leading thinkers about Social Security reform, what could a person like that do? Could a person like that just offer like, you know what, I'm going to give $10 million in campaign contributions to every member of the House of Representatives and the Senate that signs a bill that solves Social Security's financing problems for 50 years.
I don't think you can buy votes. I think that's still illegal.
No, okay, but I'm just trying to think outside the box.
That's not like the idea.
I'm trying to think outside the box. It's not partisan. It's not saying raise taxes. It's not saying lower benefits. I'm just trying to think outside. If you're one of these ultra wealthy people who love your country and you're trying to think about how can you help, because the ultra wealthy are not very, they're not leaning into this issue. Maybe I'm wrong, maybe they are behind the scenes, but I'm just trying to understand, because I think there are a lot of people who love, you know what I mean, who want this thing to be solved, and they don't know the answer, but there's no sense of urgency. So I'm just trying to think of some forcing event that prevents us from going to the 2033, let's just finance it out of general revenue. And we're not asking, my 15-year-old daughter and her generation, is that what you guys want us to do? Do you know what I mean? Like that is they don't get a vote in this, because I do feel like there's this intergenerational issue that we haven't touched on a lot today.
That's the default. That sort of Andrew's saying he's not worried about his benefits.
I don't know. I'm not literally suggesting they buy votes. Once again, I don't even know what the answer is.
You want to cut the bend point for poor people. You want to buy votes. You're just batting off.
I know. Just batting off. It's true. So, but can you?
It's so much more emotionally satisfying, Mark, to just tax it out of them instead of having to do it this way.
No, but if you love your country and you view this as a threat to the economic health of the country, and you're like, how can I help?
I do think paying more taxes should be on the table. Today I focused only on payroll tax options, in my initial remarks. But I think there's a lot of room to have wealthy people in this country pay more in taxes. And that could go towards Social Security, it could go to other, really important national needs. And I think, my graph at the beginning was about increasing inequality in wages, but the real inequality, the big changes are happening not in wage income, but in other forms of income. And so I think we need to think about that. And I think one possibility for that, which addresses not only the fact that our higher income people and our higher wealth people are getting their income in non-wage compensation, and this generational question that you brought up, is thinking about something like a net investment income tax. So we already have that in Medicare. Well, sort of. It's complicated, but that would tax. There's for Medicare payroll tax, there's instead of the capped tax that we have in Social Security, there's no payroll tax cap, and not only that, but there's a somewhat higher tax rate on higher earning workers. And in order to address this fact that many of our highest income people are getting a lot of their compensation through investment income, there's also this net investment income tax of 3.8%, same as the high wage Medicare payroll tax. And that addresses two problems. One, it brings in a lot of revenue. And the other is this generational thing that you're saying. The baby boomers really they're not going to be tapped for this. They're not going to have their benefits cut because they're going to be protected. They're not going to have their payroll taxes increased because they're moving out of the labor force. But they actually do have significant investment income. And so this is a way that we can make the older generations be part of the financial solution for Social Security and our other national needs as well.
And I don't know how the educational, you have like foundations, like Peterson Foundation has theirs, they're putting money into educational fiscal campaigns as well. I don't know how you get the kitchen table conversation back again in middle America so they actually want to understand this stuff.
But they do want it.
Well, but no,
it's always at the top of, they do want it.
When you survey, but when you go ask them questions, they don't know, they don't understand it, which means
well, they might not understand.
We're not doing our job. Again, I don't want to say our job is to go out, but we are educators, right? We're basically educators, but how do we actually help transmit the information? And I'm not trying to say people, they're busy. The transaction cost of learning everything about fiscal policy and Social Security when you're in your 20s and 30s, when you've got kids, you've got a job, they don't have the time. And this goes into the idea, even thinking about having discussions now on the Hill about work requirements for SNAP benefits. Some people, even if it's a good philosophical idea, they're busy, they're constrained mentally, they're constrained with work, sometimes they can't figure out how to fill out the forms. And you're then trying to say, how do you have these conversations? They know potentially something has to be done, but they don't know all the options. And I think that's a big challenge we have, is getting America to understand the urgency now. I don't think, you ask them in a survey, of course they want to reform Social Security. But when you do these poll questions, I've seen questions like we did at the National Academy of Social Insurance. One was, would you be willing to pay 2 cents more, 2 pennies to save Social Security? If you ask me, are you willing to pay 32% more in taxes? The answer is no. So it changes on the framing. And so I think we really have a lot of work to do. And I don't know how to.
Okay, I'm going to get fired from my job as moderator. So, sorry, we're out of time for questions. I'm so sorry.
But we will be outside at the reception.
We will, yes, and we're standing between people in the reception, so we have to move to the reception. So I will just say, so I think, Gopi, you had some closing remarks, or maybe Mark, I'm not quite sure. But thank you, everybody, for your attention to this, the last session of the day. Very much appreciate it. Thank you both to Kathleen and Jason.
Thank you so much. That was a great last session to end on, and it doesn't have to end the conversation because we will have a reception in just a few moments. So I just wanted to kind of highlight some of my big takeaways from the day. I mean, I think that the rising life expectancy inequality is just something new that is going to have to be contended with when these discussions finally kind of come to the table. The uncertainty in the program and thinking about how to address that going forward, I think, is also a huge issue. And the partisanship that we've seen, and I think leaves me somewhat less optimistic that something is going to happen in the near term. But I want to say that the dialogue that we've had today and the creative solutions and the way that we've been able to discuss these issues, even when we don't agree on everything, I think gives me some hope that when it does get discussed, that there will be a lot of experts there to provide some solutions. So thank you, everyone, for that. We are going to just close on this poll. You can go 2 slides over. It's the same thing. Okay, yes. So we are going to do the same kind of 3-question thing in just a minute. But while you are completing that, I just want to give a series of thank yous to everyone who made this day possible. The panelists and the moderators, thank you so much for being here. I think we filled all the planes coming from DC yesterday, but we've got a great group here, and I think some of you met each other in California, even though you've been working in the same space in DC, so I'll consider that a win. Of course, the CEPR staff has been amazing at getting this day just rolling smoothly, and dealing with any kinds of hiccups with such grace. And especially I want to thank Aline Kadiwal, who just did an amazing job with everything leading up to today, and thought of all of the different contingencies that could have occurred in the lead up to today's event. So let's thank Aline. And thanks again to Mark for choosing to highlight this important topic and your support for the event. I think it was very prescient of you to think about this topic. I think almost a year ago we first started talking about planning this policy forum, and I think it was a hugely successful event. So now why don't we switch over to the results. We have some results coming in even as we speak. And let's just see how people changed or did not change some of their views on these topics. Okay, so I'm going to say that we, if anything, went to, this is a more important problem to solve this afternoon than it was this morning. 97% are in the important or extremely important category. Maybe that is just a reflection of who is still here at 4 o'clock relative to who was here at 10 a.m., but I'll take it. So on the next page, I guess I'm eyeballing the distribution here, but I'm going to say it's pretty similar, maybe a little bit more central than it was in the morning in terms of splitting the ways to achieve solvency between benefit reductions and tax increases. Although, as we learned today, these are not just the only two solutions on the table. And really, it's more multidimensional than this picture suggests. And what did we take away from today? Still coming in, but solutions, I like that. So inequality and solutions, creative policy. So thank you all for your part in making today's event a success, and I hope you will join us.
Can I ask one question?
Yeah?
It would be interesting for us all to reflect on, we don't have to survey, but if you think 10 years from now, suppose we did this on the 50th anniversary, does the Social Security Trust Fund still have a positive balance? About 50-50. I want you to think about that over the next decade, plus or zero. Or maybe we'll be back. I'll be here.
All right, well, thank you so much, and we will continue the conversation. I will see you over some drinks.